All right, let's hit the movers board. Markets desk is going straight to what's actually moving. Tape's a little heavy here. QQQ down about 1.25. SPY off 40 basis points. VIX sitting just under 20. So when you've got names up triple digits against that backdrop, yeah, that sticks out. Top of the board, NTWOW, wild print, up 364% at $1.30. Then XOS, this is the liquid one, up 122%, 53 million shares already, relative volume over 1,300 times. Oof. PFSA nearly doubles, SLE up 78, WETO up 72. This board is hot, but it's small cap hot, so we're reading volume and structure, not chasing headlines blind.
All right, top of the hour. Quick market minute reset from the macro desk for anyone just jumping in. It's Tuesday, 9:04 a.m. Eastern. Cash open still ahead, and the tape is leaning heavy but not exactly falling down the stairs. SPY's at 769.5, down about 0.4. QQQ is the sore spot, 720.8, down 1.25%. Russell's only off about 1/3% at 303.1, and VIX is sitting 19.65, up just under 1%. So the story is not broad panic, it's more mega cap growth is getting tapped on the shoulder, and the rest of the market is saying, yeah, we saw it. But nobody's screaming yet. Cross asset, the message is pretty clean. Bonds aren't having a tantrum. TLT at 81.32 is down only 0.04%. IEF at 92.81, down 0.03%. So this doesn't look like a big rates shock, at least not from the ETF tape. Gold is softer. GLD around 403.11, down 0.59%. While oil is firmer at 131.20, up 0.70%. That combo says the market's not buying a full safety bid, but energy still has a little heat under it. Yen proxy's softer too. FXY 57.44, down 0.15%. Even if you only trade US stocks, keep an eye on yen pressure because when FX starts wobbling, equities usually get the memo late, like a committee meeting. Crypto-linked names are red as well. BITO down 0.44%, Coin down 1.49%, NSTR down 1.67%. So the speculative sleeve is not leading. What I'm watching next, QQQ holding that 720.3 to 720.7 area from the early tape, VIX around the 20 handle, and then the real macro calendar. Building permits and housing starts hit at 12:30 Eastern. Industrial production at 1:15. Pending home sales at 2. Coming up after this reset, we'll hit the market mover scan. Thanks, Markets Desk. Quick macro check, because this tape is telling one pretty clean story. SPY's sitting around 769.49, down about 0.4. QQQ is the sore thumb, 720.75, off 1.25%. Russell's down 1/3, so small caps aren't exactly throwing a party either. But the pressure is really in long-duration growth. VIX is 19.65, up just under 1%. So this isn't full panic. It's more like the market turns the risk thermostat from hoodie weather to, all right, maybe grab a jacket. The level I care about on the NASDAQ side is that 720 area in QQQ. That's where the tape is trying to base after failing near 722.50. Above 722.50, the growth side breathes a little. Lose 720 cleanly, and this starts feeling less like chop and more like sellers are pressing. Now here's the macro plumbing underneath it. Bonds are not really riding to the rescue. TLT at 81.32, down fractionally. IEF at 92.81, also a little red. Tiny moves, sure, but for mega cap tech, even tiny rate pressure matters because those stocks trade like the market's very expensive couch. Comfortable, but you notice every scratch. Oil is up 0.7% around 131.20, while gold is down about 0.6 at 403.11. That combo matters. Oil firming can keep the inflation conversation alive, but gold fading says this is not a classic run for the bunker morning. Yen proxy is softer at 57.44, down about 15 basis points. And crypto risk proxies are heavy too. BITO down 0.44%, Coin down 1.49%, NSTR down 1.67%. So the chain is no bond relief, energy firmer, risk proxies weaker, and QQQ takes the punch first. Also, the live dollar feed on this portal is giving me a bad zero print, so I'm not going to pretend that's useful. MacroDesk has standards, occasionally. And the calendar still matters here, because the next couple prints hit the exact parts of the market that are already acting heavy. Building permits and housing starts are at 12:30 Eastern. That's your rate-sensitive read-through for home builders, REITs, the real estate sleeve, even some of the regional banks' sympathy if yields start moving. Import and export prices are on the docket too, so that's the inflation pressure check. Then industrial production at 1:15, that's more of the real economy pulse. Factories, utilities, cyclicals, all that stuff. Now, on the actual levels, QQQ is the cleanest tell for me. It tried that 722.50 area, failed it, and now it's basically hanging around 720. If 720 starts slipping with volume, that's where the tape can get a little more sloppy. If it reclaims 722.50, okay, then maybe buyers are trying to clean up the failed breakout. VIX is still just under 20, so 20 is the line for whether this goes from normal red tape to a little more stressy. Oil's holding near 131, energy stays in play there. And gold near 403 is softer today, not really acting like a big safety bid. All right, that's the macro map. Let's kick it back to the movers board and see where the actual flow is hiding. All right. Let's put the wide-angle lens on this tape for a minute. Here at the macro desk, the thing that jumps out is not just that stocks are red, it's who's red. SPY's off about 0.4 at 769.26. IWM's down a third at 303.07, but QQQ is getting hit harder, down 1.28% around 720.54. That's the market saying the pressure is concentrated in long-duration growth, not a total liquidation. And VIX at 1965, up less than 1% is important. It's elevated, yeah, but it's not screaming. So this is more of a controlled de-risking than somebody yelling fire in the theater. The little QQ box we flagged earlier, 720.3 to 720.7, is still the first tell on whether tech stabilizes or leaks lower. Now the reason that matters is the cross-asset chain. Oil's firm again, USO proxy at 131.20, up about 0.7%. And the headline backdrop is still that US-Iran ceasefire expiry risk. That keeps an energy premium in the system. But gold's not acting like the world is ending. GLD's down 0.59% at 403.11. Bonds are barely moving too. TLT down 0.04%, IEF down 0.03%. So you don't have the classic panic package of oil up, gold ripping, bonds bid, volatility exploding. What you've got is more annoying than dramatic. Oil pressure without a safety valve rally in bonds. Inflation's the house guest who keeps saying they'll leave after one more coffee. And that's why NASDAQ is the weak spot. Higher input cost anxiety plus no bond relief is not exactly a spa day for mega cap growth. The FX side is the one I don't want to ignore here. Dollar feed on the board is giving us a bad zero print, so I'm not going to pretend that's a clean read. But the yen proxy FXY is sitting 57.44, down about 0.15%. And yeah, FX still matters for U.S. equities, even when it's not the headline, because it feeds right back into financial conditions, carry trades, and the mega cap tech multiple. When yen stays soft and oil stays firm, that's not exactly the cleanest risk-on backdrop for QQQ, when QQQ is already down about 1.3%. And look at the crypto proxies. BITO red by about 0.4%, Coin down almost 1.5%, MSTR down about 1.7%. Crypto names are always noisy, super volatile, and frankly a different risk bucket. But as a risk appetite read, that's not screaming animal spirits right now. So, the quick watch list into the next hour, QQQ, I'm watching 720.30 on the downside. That's basically the low area, and 720.70 back above as the first tiny repair level. VIX at 20 is the line in the sand for whether this turns into a more defensive tape. Oil keeps staring at that 131 area, because if energy stays bid while tech is heavy, that cross-asset mix matters. And don't forget, 12:30 Eastern, we've got the housing data, so macro can still kick this thing around. All right, we'll keep those levels on the board. Let's hand it back into the single name action and see where the tape is actually paying traders right now.
Thanks, Macro Desk. All right, back to the movers board. Quick score check. Not going to rechew the same breakfast here. NTWO is still pinned at the top. XOS is still the wild volume name. PFSA is still hanging in that tiny float zone. But the market backdrop matters. QQQ's down more than 1%. SPY and IWM are red. VIX still under 20. So if a small cap is holding green with real volume, that relative strength gets my attention. Here at the markets desk, I want the next shelf now. SLE, WETO, SGLY, BIAF. That's where the board gets interesting, because these aren't just cute percent moves. We've got real volume pockets, high beta charts, and probably some ugly wicks if the bids start disappearing.
Breaking right now. Bond yields jump. Oil extends gains as the U.S.-Iran ceasefire expires. Here's what we know. Brent crude surged about 2.4% to around $90.65 a barrel after the 60-day ceasefire expired without renewal. On our board, oil is still sitting around 131.2, and yields are backing up because the market is immediately repricing energy inflation risk. What we don't know yet, whether this becomes a real physical supply disruption, whether shipping gets delayed, or whether this is just the market slapping a geopolitical tax on every barrel. The market read is pretty clean. Higher oil plus higher yields is not exactly a spa day for growth stocks. QQQ is around 720.4, down 1.3%, while SPY is off about 0.5%. Next headline. European stocks are falling as the Hormuz stress spills into global risk appetite. ProTerminal's newsroom is tracking escalating tension around the Strait of Hormuz, including threats aimed at Oman, with traffic through that choke point collapsing. And that matters because Hormuz is not some side street. It's major energy plumbing. If that route gets even questioned, the market immediately starts marking up oil risk, shipping risk, insurance risk, and then, European equities feel it first because energy sensitivity is higher over there. VIX at 19.66 is not panic, but it is the market clearing its throat. Third big one, different lane. NVIDIA is set to provide up to a $105 billion guarantee for OpenAI's Ohio data center. That is a monster AI infrastructure number, and it tells you the AI CapEx cycle is still swinging a very large bat. Why it matters. NVIDIA is not just selling chips into the boom anymore. This puts it deeper into the financing and strategic backbone of the build-out. Great growth story, but also a bigger capital deployment story. And on a morning where yields are jumping, that duration math matters. Coming up, Megacap Watch can put NVDA on the chart and see whether traders are treating this as leadership or just another expensive bar tab from the AI party.
All right, let's pull up Apple, because this is the Megacap chart I care about right now. QQQ's red by a little over 1%. Apple's still greenish, around 307, so that relative strength matters. On the daily, this thing had the big run from the mid-250s into that 344 area, then boom, sharp correction, heavy sell days, flush down toward the 270s. Now we're not trending cleanly higher yet. We're basing. Low 300s, tighter bodies, smaller ranges. That's the whole read here at the markets desk. After a nasty reset, Apple is trying to build a shelf. Now levels. Keep this clean. The daily support zone is basically 302. Call it 302.05 from the chart package. If Apple loses that, the base stops looking calm and starts looking like a failed hold. Upside, I'm watching 310.70. That's the nearby resistance zone, and it lines up with that 309-ish moving average area from the technical package. Above 310.70, Okay, now Apple is repairing. Below 302, not so pretty. Also important, the sell-off volume confirmed the drop, but this sideways action has come on lighter volume, so I don't want to overcredit the base until we see actual participation. Let's drop down to the 1 minute, and yeah, this is tight. Apple opened this read around 307.77, high is 307.85, low is 306.75, and right now it's just hanging near 306.80. That's not a breakout. That's not a breakdown. It's a little pre-market box. Lower highs into basically flat lows. Classic compression. Oof, look at those tiny candles near the bottom of the range. Early volume came in on the dip from 307.70 down toward 307.20, but after that, the tape went quiet. So the market's leaning risk off, Apple's holding up better, but intraday it still needs to prove it. So the scorecard is simple. Above 307.85, that's the range high. I'd want to see volume show up, not just one little wick through it. Below 306.75, that lower edge cracks, and then Apple loses the microbase. Until one of those breaks with real volume, this is chop with relative strength. Big difference. And with QQQ still sitting heavy near the macro desk 720 area, Apple can be strong and still get dragged if the Nasdaq rolls. Coming up, we'll snap back to the movers board and see where the real pre-market heat is. All right, let's pull up Apple, because this is the weird one on the mega cap board. Nasdaq's heavy, QQQ's down about 1.3, and AAPL is actually green. That matters. Here at the markets desk, I'm not ignoring that kind of relative strength. Daily chart first. This thing's not breaking out, but it is holding that 305 to 310 pocket after the pullback. Okay, bigger picture. Apple's been a range name, not a clean trend name. You had that big push into the 334, 344 area, then the rug pulled back down, and now it's trying to build this little base in the low 300s. The important thing, price is still below the short-term moving averages. The 50-day is basically that 309 zone, and the 20-day is up near 317. So if AAPL wants to repair the daily chart, 309 is the first real reclaim I care about. Above that, 317 is the next test. If it can't get through there, this is still just a bounce inside a wider range. Down below, the big structural line is not here. It's way lower, around 275, with the 200-day sitting closer to 280. So daily chart says, holding, yes. Now let's drop down to the 1 minute, because this is where you see the actual tape. And yeah, tight, really tight. AAPL's boxed between roughly 306.65 on the low end and 307.50 to 307.80 on the top end. Open was around 307.70, so it's hovering just under that, not exactly screaming momentum. Oof, look at that lower end push. Sellers got it down toward 306.65, but there's no clean flush yet. That's the key. Volume popped on the minor sell-offs, but follow-through has been weak. So for me, 306.65 is the line where the intraday character changes. Lose that with volume, and the tight range gets sloppy. Reclaim 307.50, then you can start talking about Apple repairing the micro tape. Until then, it's chop. It's a level tape, not a chase tape.
Thanks, Markets Desk. 9 minutes to the 9:30 bell. So here at the macro desk, let's set the room before the auction starts yelling. The equity tape is risk-off, but not table flip risk-off. SPY's around 769, down 0.48%. QQQ's the weak kid at 720.4, down 1.29%. IWM's off 0.38% at 302.9. And VIX is only 19.66, up less than 1%. So the message is pressure, not panic. The cross-asset chain is pretty clean. Oil still bid at 131.13, up 0.64%, which keeps the inflation risk thermostat turned up. Bonds are not exactly riding to the rescue, with TLT and IEF both down 0.04%. Gold softer at 403.06 after tagging that sub-403 callout a few minutes ago, and the yen proxy FXY is down 0.15% at 57.44. Translation: the market is nervous about energy and rates. but it's not hiding under the desk. That's why tech is wearing the bruise. QQQ is pinned near the lower end of its pre-market range, and 720.3 is the line the opening auction has to respect. Okay, the bell setup is basically this. Does the oil and yield worry stay in the macro box, or does it leak into the opening prints for growth? Crypto beta is already a little chilly. BITO at 8.66, down 0.35%. Coin at 148.01, down 1.69%. NSTR at 96.13, down 1.59%. So it's those stay heavy while QQQ can't reclaim 722. That's the risk appetite smell test. On the other side, if VIX can't punch through 20, and QQQ repairs back above 722, then the opening auction may say fine, scary headline, but not a full de-risk. The names I'm watching at the open are simple. NVDA as the AI mood ring, AAPL because the markets desk just mapped the opening range, and then the wild small cap gappers, XOS, NTWO, SLE, just to see whether pre-market volume survives the first 5 minutes. Concrete macro marks into the bell. QQQ below 720.3 is downside confirmation. QQQ above 722 is first repair. VIX above 20 means hedges are waking up. Oil staying above 131 keeps the inflation story loud. And gold losing 403 says safe haven money still isn't rushing in. 9:30 is where the polite pre-market opinions become actual orders.
Thanks, macro desk. All right, back to the movers board, because this tape is still risk off, and these small cap names are doing their own thing. QQQ's down more than 1%, SPY is red, VIX is hanging near 20, and then you've got NTWOW still up 350%. That's not market beta. That's pure event flow, SPAC-style chaos. SLE is the one I care about first, because our $6 level already hit, score 1 for the board. And now it's sitting right around 6.54, up 116%. XOS is also huge on the board, up 116%, but the crazy part is the relative volume, over 1,400 times normal. PFSA is almost doubled, but relative volume is light on the board, so I'm not treating that the same as XOS or BIAF. And BIAF, oof, 107 million shares already, 227 times relative volume, 53-cent stock. High-risk microcap energy all over it. So here's the plan. Fast charts, no love letters. We're going SLE first, then XOS, then the cleaner volume names. Let's pull SLE first. This is the follow-up chart. Earlier we flagged 6 as the key break. And yeah, that got tagged. Now the market's asking a different question. Can it actually hold above the breakout, or was that just the pre-market squeeze candle? Board has this at 654, up 116%, 18.9 million shares, basically 30 times relative volume. Float is only about 1.6 million, and dilution risk is marked high. So this is exactly the kind of name where the candles can look amazing for 3 minutes and then just rug you. The market's desk line here is simple. 650 is the first character test. If it's holding above 650, bulls still have the bid, and 7 becomes the obvious round number test. If it loses 650 with volume, I'm not pretending the setup still looks clean. Then you're back to asking whether 6 can hold as the prior reclaim. Fast name, tiny cap, great for learning tape behavior. XOS next. And this one's all about follow-through now, not the headline move. The headline is crazy enough. About 54.7 million shares, roughly 1,400 times normal volume. Stock sitting around 4.52. Up over 100% while QQQ is still red. So the tape is definitely noticing it. For me, the line is 4.50. If this thing can actually accept above 4.50, not just poke it, not just wick it, that's where you can say, okay, buyers are still in control on the 1 minute. If it keeps losing 4.50 and the candles start getting heavy, then that's where the move starts looking more like churn after the squeeze. Also, high dilution risk on this name. So yeah, you respect the volume, but you don't marry the story. Now, BIAF, totally different animal. This is a 53-cent healthcare microcap, and the volume is enormous. 107 million shares traded, about 228 times average volume. But this is exactly where you've got to separate real bid from penny stock trap behavior. Floats around 4.4 million. Market cap's only about 4.4 million, and the dilution risk is marked high. So huge tape doesn't automatically mean clean tape. I'm watching that $half area. If 50 cents keeps acting like support and the 1-minute candles stop dumping every pop, okay, that's a clear sign. But if it's just spike, wick, reclaim fails, spike, wick, that's classic microcap distribution behavior. The volume is real. The question is whether the bid is real after the initial rush. AMLX is the cleaner healthcare move on this board. Not the craziest percentage move, but this is a real company-sized tape compared with the microcap stuff we've been staring at. About a 3.2 billion market cap, stock around 29.44, up 37%, and volume is only about 2.4 times normal. So that's a totally different feel than BIAF doing 200 plus relative volume. On the 1 minute, I'm less worried about some one candle squeeze and more about whether buyers are actually defending the high 20s after the gap. If this holds above 29, that tells you institutions aren't just fading the first print. If it loses 29 cleanly, then yeah, some of that cleaner liquidity can still turn into a gap and trap, especially with QQQ still down over 1% on the day. Weave now, and this is the sneaky one, because it's an NYSE software name, not a tiny low-float biotech runner. Stocks up about 32% at 731, volume just under 2 times normal. So the question is pretty simple. Is this actual momentum, or did it just gap and sit there thin? I want to see if 725-ish keeps acting like a floor on pullbacks. If it can't hold that area and starts chewing back towards 7, the move starts looking more like a repricing gap than an active momentum name. But if it keeps building above 725 while the Nasdaq is red, that relative strength is worth noticing. All right, last pass here, SXTC first. And I'm not treating this like a clean quality move. I'm treating it like a healthcare risk name that's got filings on the board and high dilution risk showing. It's around 480, up 28%. Volume's about 9 million, so there is attention here. But for me, the 1 minute has to prove it can actually hold that 480 area and then deal with 5. If it's under 5 and chopping, that's not momentum. That's just noise. PFSA next. This one is even more violent structurally. Tiny float, roughly 604,000 shares. Stock near 889, up 96%. That can move insanely fast both ways, so I'm watching 9 as the pivot, and I'm not chasing candle tops on something like that. Quick revisit on WETO. We wanted to see if it could recover toward 44.45. Board price is still around 41.75. So no, that level has not been reclaimed yet. Until it gets back into that 44 handle, it's still a failed reclaim look. And SGLY, this one's actually behaving a little better. 678, so it's above that 650 line, but still not clean through 7. That's the battle. Respect 650, fine. Reject 7, it gets heavy. Good mover scan. Coming up, we'll shift off the runner board and hit the next setup on the rundown.
Thanks, Markets Desk. Let's pull the AI infrastructure chain back on screen. Here at the company desk, the question is simple. What does this actually change? NVDA has this massive OpenAI infrastructure commitment out there, but look at the tape. QQQ's down about 1.3%. NVDA's down a little over 2%, around 220. So the market is not just blindly cheering the headline. That 220 area matters for the story today. If it loses that cleanly, the market's basically saying, great strategic headline, but macro pressure and funding risk still matter. Okay, here's the actual business story. This is not just, quote, NVIDIA sells more chips. The press release says NVIDIA is backing the Ports Pike Technology Campus in Ohio, with OpenAI as the customer for an 8 IT gigawatt campus. NVIDIA is providing credit support tied to land, power, and shell buildout, starting with 4.25 IT gigawatts, with an option on the rest. That is a very different role. NVIDIA is moving from pure supplier into ecosystem financier. That can help pull future GPU demand forward, sure, but it also puts NVIDIA closer to the infrastructure balance sheet. Bigger opportunity, bigger responsibility. That's why I'm a little skeptical of anyone treating this like a one-line bullish catalyst.
Thanks, company desk. All right, cash market is open, and here at the macro desk, this is not a sleepy bell. SPY sitting around 768.9, down about 0.5%. QQQ is the sore thumb, 721-ish, off 1.2%. And that tells you right away where the pressure is. Duration-heavy growth, mega-cap tech, the stuff that gets grumpy when oil and inflation anxiety walk into the room wearing boots. IWM's only down about 0.4 at 302.8, so small caps are not the disaster zone yet. VIX is 19.64, up but not exploding, so this is risk off, not everybody under the desk. The first line I care about on this open is QQQ 720. If that level starts leaking, the Nasdaq weakness becomes the morning's main character. All right, breaking news first. Robinhood is ripping after getting added to the S&P 500. ProTerminal's newsroom is tracking Hood shares up 14% on the index inclusion headline. What we know? Robinhood is being added to the benchmark, and that usually brings mechanical demand from index funds and ETFs that need to own the name. What we don't know yet, how much of this first move is forced index buying versus discretionary traders chasing the headline. And we don't have the exact flow number on the tape yet. But here's the market read from the macro desk. SPY is down about 0.5%, QQQ is off more than 1%, and Hood is up double digits. That's not just green. That's green wearing a traffic cone vest. Index inclusion can change liquidity, ownership base, and attention. But the next question is whether the stock holds that premium once the mechanical bid gets digested. Next headline, Broadcom shares are rallying on a $10 billion OpenAI deal. This is the AI infrastructure story broadening out again. The company desk was just on the NVIDIA OpenAI funding angle, and this Broadcom headline is the other side of that same coin. Custom silicon, networking, infrastructure, the plumbing behind the model boom. Why it matters? If AI CapEx keeps moving from one-chip story to full-stack build-out, AVGO sits closer to the toll booth than the billboard. Still, the market is not exactly throwing a party for growth this morning. QQQ is sitting around 719 and down 1.4%. So the real tell is whether Broadcom can stay bid while the broader tech tape is under pressure. And third, Kenvue is under pressure, down 10%, after ProTerminal's newsroom picked up a report that RFK Jr. may claim a link between Tylenol and autism. Facts first. This is a headline risk move right now, not a final regulatory finding in the data we have. Why it matters for investors is pretty straightforward. Tylenol is a major consumer health brand, and when the market hears potential litigation risk plus reputation risk, it discounts first and asks beautifully organized follow-up questions later. That's Wall Street's bedside manner. Terrible, but efficient. For KVUE, the issue is whether the stock is reacting to a one-day headline shock or pricing a longer legal overhang. Coming up, we'll kick it back to the movers board and see which of these headlines is actually getting follow-through on the tape.
Thanks, macro desk. All right, markets desk is on the movers board, and this is where the tape gets spicy. QQQ is under that 720 line they flagged. SPY is red. VIX is still hanging just under 20. So any green on this board has to be judged as relative strength. But also, yeah, small cap chaos. NTWO is parked at the top. SLE is still doubled, and XOS is the volume freak on the board. I'm not going to waste time rereading every percentage. The question now is simple. Did the opening volume stick, or is this the first 5-minute rug pull? NTWO is a SPAC shell company type name, SLE is tiny float with high dilution risk, and XOS already gave us the clean score. That 4.50 upside level hit. Okay, pull up XOS first, because this is the cleanest scoreboard name. 1-minute chart, and oof, this is the kind of tape where you do not blink. Price is sitting around 4.54, up about 117%, and the big number is the volume, roughly 60 million shares already against an average under 40,000. That is absurd relative activity. The desk flagged 4.50 earlier, it crossed, so now the read changes from breakout to acceptance. If XOS starts living under 4.50 again, that's a failed reclaim look. If it keeps building above it, then the shorts are still under pressure. Also, don't ignore the structure underneath. Float is under 8 million, dilution risk is marked high, and these high relative volume industrial runners can go from squeeze to air pocket real fast. So for the markets desk, 4.50 is the line on this one. Not a trade instruction, just the tape check. Now, NTWAOD is the weird one on the board. Pull this up and just remember what we're looking at. This is a SPAC shell company name, Newberry Street 2, up 346% at about $1.25. But the volume is 722,000 against an average of basically 4,000. So yeah, the percent move looks insane. Relative volume is massive, but this is exactly where you ask, is there actual bid underneath it, or did it just print into a thin book and light up every scanner on Earth? For me, the tell is whether it can keep building above that $1.20 area and not just instantly round trip the opening pop. If this starts slipping under 120, I'm treating that as headline board spike behavior, not clean momentum. Back to SLE now, because this one actually has the better trading battle on the tape. We already talked about the story, so I'm not redoing that, just the chart. Price is sitting around 6.85, up about 127%, and it's still that 650 versus 7 fight. 650 is the line where buyers have to keep showing up. If that level starts getting chewed through, the momentum crowd usually backs off fast. But if it keeps reclaiming towards 7, that's where supply has been sitting, and you can see why. Tiny float, 22 million shares traded, high dilution risk. Everybody's watching the same tape. Cleanest read, above 7, it can keep squeezing shorts and late chasers. Below 650, the character changes pretty quickly. PFSA next, and this one is a classic healthcare momentum risk check. It's up about 116%, trading around 9.78. So yeah, the headline move is huge, but the structure matters more than the scoreboard number. Float is tiny, about 600,000 shares, and the board is also tagging high dilution risk. So this is exactly the kind of name where the 1-minute candles can get nasty fast. The weird part is the relative volume print, 0.45, even with almost 11.6 million shares traded, because its average volume is already massive. So I'm not treating that as quiet. I'm treating it as, okay, this man has already been in play. Now we need to see if today's open is actually holding. For me, the clean read is simple. Can it keep reclaiming that $10 area? Or does it start rejecting under 10 and leak back toward 9.50? Tiny float, healthcare, high dilution flag. Respect the move, but don't marry the candle. Now, AIXC. Quick pass here. And this one is not moving with the same punch as the leaders. It's up about 68% at 1.19. Volumes 2.8 million. Relative volume 2.33. That's active, sure. But it's not XOS type insanity. And it's not BIAF type churn. Also, don't let the ticker confuse the story. AIX Crypto sounds like a crypto AI flyer, but the company description on the board is healthcare, clinical stage therapeutics, cancer program, pharma bucket. So I want the tape to prove itself here. If it's holding above 120 and building higher lows, okay, there's some actual demand. If it keeps failing 120 and slipping back toward 110, then this starts looking more like a name catalyst confusion pop than clean momentum.
Thanks, Markets Desk. Quick stock whisperer check-in on the simulated paper book. Hood just hit our trigger, so we're long 75 shares at 94.50, and it's basically flat to slightly green right now at 94.52, up $1.50 on the position. The setup is pretty simple. Pro terminal flagged the S&P 500 inclusion catalyst. The stock held the opening push, then extended through 94.50 instead of rolling back into the gap. I'm not chasing the headline blindly here. This is thesis, level, defined risk. The thesis is index inclusion flow. The trigger was 94.50. The risk is that it loses that post-open support area and the inclusion gap starts to fade. Now the bracket is already sitting there. Stop at 91.80. Take profit limit at 101.50. Again, this is the broadcast's simulated paper portfolio, not a recommendation to copy it. But that's the discipline. If Hood keeps building above 94.50, great, the trade has room. If it fails back through the support zone, the stop does its job, and we grade it honestly. Rest of the book is calm. AVGO long 20 is basically flat, up about $1. still tied to that OpenAI deal catalyst. TSLA Long 25 is the best open piece, up about $147, still working with the bracket at 355 over 322. Coming up, we'll kick it back to the movers board and see where the opening volume is actually sticking.
Thanks, Stock Whisperer. All right, Pro Terminal News Brief, and first up is XOS. The company secured a U.S. Air Force contract to deliver a prototype ruggedized mobile battery energy storage system. That matters because it pushes XOS into the defense market, not just commercial EV fleets. And the tape is treating that like a validation headline. The macro desk likes the customer vertical. The caveat is that defense revenue can move at the speed of a fax machine in a federal building. So execution and follow-on orders are the real next questions. Next headline. SLE, Super League, reporting Q2 2026 results with net revenue up 16% sequentially, gross margin expanding 5 percentage points to 41%, and adjusted EBITDA improving about 20% year over year. Why it matters. This gives the market an operating leverage story, not just a random small cap candle. In gaming and media activation, margin expansion is the part investors can actually underwrite. Revenue growth is nice, but margin improvement is where the grown-ups in the room finally look up from their coffee. Now put those two together. XOS has the government contract angle, SLE has the margin improvement angle, and both are moving in a tape that is not exactly throwing confetti. SPY is around 769.4, down 0.42%. QQQ is 721.9, down 1.10%. IWN is 302.8, down 0.40%. VIX is 19.57, still under 20. So the story is simple. Single name catalysts are working, but they're swimming upstream against a growth tape that's still heavy. Cross-asset backdrop is pretty clean too. Bond ETFs are barely moving, with TLT around 81.30 and IEF around 92.79, so this is not a giant rates shock right now. Oil is the loud one, roughly 131.20, up 0.7%, while gold is softer near 403, down 0.6%. Crypto beta is also leaning red. BITO around 8.65, Coin down 1.86%, MSTR down 1.91%. Translation: risk appetite is selective. The market is not broken, but it is making stocks show ID at the door. Calendar-wise, the desk doesn't get the next big scheduled macro checks until 12:30 Eastern, with building permits, housing starts, and import-export prices. Industrial production hits at 1:15, then pending home sales at 2. Until then, these stock-specific headlines are doing more of the steering. Coming up, the movers scan is next. We'll see which gaps are actually holding bid.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board, and I'm not rereading the whole thing. QQQ is still down more than 1%. VIX is parked just under 20. So if you're green today, you're earning it. Top row is NTWOW, monster percentage move, huge relative volume. But yeah, SPAC shell energy, so we're treating it like tape, not like a clean fundamental story. PFSA, AIXC, SLE, XOS still stacked right underneath. We're going chart by chart now. Okay, NTWOW on the 1 minute. Price is around $1.23 after that wild gap, and the funny part is the absolute volume isn't gigantic. About 743,000 shares, but versus a tiny 4,000-ish average. That's why the relative volume looks ridiculous. Here's the level game. I care about 120 holding. If buyers keep accepting above 1.20, the squeeze tape can stay alive. If it starts holding 1.25 and the offer stops reloading, that's your cleaner reclaim look. But under 1.20, oof. That's where these shell company momentum names can air pocket fast. Not calling it clean, not chasing the headline percentage. Here at the Markets Desk, I'm grading 1.20 support and 1.25 reclaim. PFSA now. This is the one I want to slow down on for a second, because that $10 hit was the line. We're around 1160 on the board, up about 157%. But the important part is the structure. Tiny float, roughly 600,000 shares, and dilution risk is marked high. So yeah, it can move like crazy. But that cuts both ways. If 10 stays reclaimed, bulls at least have a level to lean on. If 10 fails again, that's where these low-float healthcare squeezes can turn into elevator-down candles real fast. I'm not chasing the headline here. I'm watching whether the tape actually accepts above 10 or if that was just a liquidity grab. AIXC next. And this one's basically sitting right on the decision area we talked about earlier. Board has it near $1.51, up about 113%, with volume just under 4.8 million. So there's activity, but the fade zone is still the same. $1.50 is the spot. If it keeps holding above 150, okay, the chart can keep trying to build. But if it loses that and starts rolling, then 120 and 110 are the next places I'd expect traders to look for buyers or a bounce attempt. Also, same theme as a lot of these. High dilution risk, small cap biotech style tape. So don't treat a green percentage like it means clean liquidity. SLE now? And yeah, this one's still got that earnings day momentum look, but the chart is telling you the fight is not random. Board has it around 633, up basically a double, 22.8 million shares traded, 36 times normal volume, and the float is only about 1.6 million. So when this thing gets above 650, it can get jumpy fast. But if it keeps rejecting under 650, then 7 starts feeling a little far away instead of automatic. That's the whole read here. 650 is the near-term pivot, 7 is the big psychological magnet, and with the market soft, QQQ still red. This kind of relative strength is real, but it's also exactly where low float names can rug you if volume dries up. XOS next. This is the contract volume one, and the volume number is just ridiculous. 65 million shares, relative volume over 1,600 times normal. But here's the key. That 450 breakdown we were watching, that got hit. Price is now around 434, so it's below the level, and now 450 flips into the test from underneath. If it reclaims 450 and holds, okay, maybe buyers are still there. If it can't even get back through that spot, then this is more of a fade after news tape, even though it's still up over 100% on the board. Big move, huge liquidity, but the level matters more than the headline right now. All right, quick flip to the red side now, because this is where people get chopped up trying to be a hero. LGCL first, 49 cents, down 65%, volume about 650,000. So yes, relative volume is elevated, but this is not the same tape as those upside runners. Under $1, broken chart, small float around 1.1 million shares. That can bounce violently, but the cleaner read is, can it reclaim 50 cents and actually hold it? Or is every push just getting sold into? I'm not calling bottoms on a name that's already sliced this hard. Now UCL, same idea but louder volume. 46 cents, down 32%. 4.5 million shares, relative volume over 250. That's real activity, but it's still a sub-dollar loser with high dilution risk on the board. For me, the line is super simple. If it's living under 46, 47 cents, sellers are still in control. If it reclaims that zone and holds, then maybe the tape firms up. Until then, no hero bottom language, just liquidity, levels, and respect the downside trend. Last quality pass through the rest of the green board. Guido's the first one, 38.86, up 58%, and this actually has a cleaner reclaim look than a lot of the tiny names. Almost 4 million shares, relative volume 87, float around 5.7 million, so it can still move fast, but the tape is more readable. I'd keep 38.39 on the screen. Above that, the reclaim is still alive. Below it, the move starts looking more like a failed pop. EJH next, $2, up 42%, 12.5 million shares, relative volume over 100. That's momentum, but it's also a $5.7 million microcap with high dilution risk, so don't confuse movement with quality. $2 is the line everyone sees there. And then AMLX, this is the cleanest liquidity name in the last batch. 28.36, up 32%, 7.3 million shares, 96 million float, 3.2 billion market cap. Very different animal than the low float stuff. Not as explosive tick for tick, but way cleaner participation. All right, that's the opening drive movers lap. Big upside in the speculative names, real damage in the sub-dollar losers, and AMLX standing out as the cleaner liquid mover. We're going to hand it forward from here and hit the next tape read.
All right. Quick pro terminal pit stop. This is the dashboard we're using all morning to keep score on the chaos. First up, Dilution Center. This page matters when the board is full of small cap runners because the chart can look clean, the candle can look spicy, and then boom, shelf, ATM, offering risk, all that stuff can change the whole setup. It's not a magic buy button. It's just the research layer you want before you start believing a squeeze. Now flip back to the movers board. This is where the markets desk lives during the open. Top gainers, top losers, price, relative volume, market cap context, all in one shot. Look, QQQ is down over 1% right now, so anything still green on this board has to be measured against a heavy tape. NTWOW up top, XOS still active, SLE still on radar. But again, these rows are starting points. They tell us where the volume is. They do not tell us what to do. Here's the next move. When a name starts moving, I'm not just staring at the green candle. I'm pulling the company profile. I'm checking filings. And then I'm checking insider activity. We'll use XOS as the example because it's been on the tape all morning. I'm not relitigating the catalyst. I want the paper trail. Recent filings, offering language, shelf capacity. Anything that tells me the risk profile changed. Then insider trades. Are there recent Form 4s? Any selling? Any buying? Anything useful? Sometimes the data is delayed or incomplete. Fine, don't force a story. But if it's there, I want it in front of me.
Thanks, Markets Desk. Breaking macro headline first. ProTerminal's newsroom is tracking bond yields jumping and oil surging as the U.S.-Iran 60-day ceasefire expires. Here's what we know. Brent crude has pushed above $90. Yields are higher, and equity multiples are getting hit by the two things they hate at the same time: a higher discount rate and a higher energy bill. Lovely little macro sandwich, basically all crust. What we do not know yet. We do not have confirmation of a physical supply disruption. We do not have a fresh policy response, and we do not have a new diplomatic extension in the data. So we're not filling in blanks with geopolitics fan fiction. Market read, QQQ is around 719.4, down 1.44%, sitting just under that 720 shelf. And USO is around 131.19, after already taking out the 131 level we flagged earlier. If oil keeps living above 131 while QQQ can't reclaim 720, that's the multiple pressure trade staying on the tape. Next card, the broader sentiment read has turned bearish, and it's not just one headline doing the damage. The desk is seeing geopolitical risk, the oil shock, rising yields, and corporate stress all hitting at once. Bally's, Nike, Stellantis, Flowtech, those names are in the mix on the distress side. Why it matters? The market doesn't need every stock to fall apart to lose risk appetite. It just needs enough pressure points for investors to start asking, wait, what am I paying for this growth? SPY is around 768.5, off about 0.5%. IWM is 302.1, also red. VIX is 19.64, so not pack, but definitely the smoke alarm chirping in the hallway. Third story, NVIDIA's OpenAI relationship is no longer just we sell the chips, you build the models. ProTerminal is tracking NVIDIA expanding into a significant financial backer of AI infrastructure. That matters because it changes the shape of the AI trade. This is supplier, financier, ecosystem builder, all wrapped together. The bullish read is obvious: deeper exposure to AI infrastructure spending. The macro desk wrinkle is also obvious. When yields jump, funding loops get more scrutiny. Without a fresh NVDA tick on this card, I'm not going to pretend we've got a tick-by-tick chart read here. But the takeaway is clean. AI demand is still a structural story, while today's rate and oil tape is making the market pay closer attention to valuation. Coming up, sector theme spotlight should help separate who's actually leading from who's just wearing the AI hoodie.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board. And yeah, this board is still doing wild stuff. while QQQ is down almost 1.5%. That matters. When the tape is risk off and you've still got NTWO, PFSA, AIXC, XOS, WETO lighting up the top of the screen, those aren't casual moves. That's hot money hunting momentum. I'm not going to reread every percentage again. Waste of time. The job now is which ones are holding bid, which ones are air pockets, and which ones are just one failed candle away from trapping late chasers. Top row first, then we go chart by chart on the 1 minute. Okay, NTWOW first, because it's still the top print on the board. Around $1.20, up huge. Relative volume about 176 times normal. Quick reminder only, this is shell company style momentum, so I'm not falling in love with the story here. The chart has to do the talking. Same scorecard from earlier. If 120 keeps acting like a floor, fine, the bid is still alive. If it loses 120, this can get slippery fast. And if it can cleanly reclaim 125, that's where the momentum crowd starts leaning back in. Oof, with QQQ this heavy, even holding flat up here is relative strength. But don't confuse relative strength with safety. Liquidity can disappear on these in 2 candles. PFSA next, and this one's nasty in a totally different way. This is healthcare, about 1326 on the board, up roughly 193%. But the big thing is the float, about 600,000 shares. That's tiny. So when this catches, it can squeeze way harder than it looks like it should, but the fade can be just as violent. I'm using the low teens as the scorecard here. If 13 keeps getting defended on the 1 minute, okay, the bid is still alive. If it starts accepting below 13, and especially gets heavy into the mid-12s, that's where this turns from squeeze into squeeze and fade real quick. Also, dilution risk is marked high, so I'm not treating this like some clean blue chip breakout. This is pure tape reading. AIXC now. Quick scorecard first. That $1.50 zone we cared about, yeah, that's no longer the main fight, while this thing's trading around $1.93. It cleared the decision area. Now the question is whether the 1 minute can actually hold the upper range, or if it just becomes churn under $2. Volume's real enough. About 8.8 million shares. Relative volume a little over 7 times. But this is another high dilution risk momentum name, so I don't want to romanticize it. For me, the immediate tape is simple. Can buyers keep it holding above the 180 area, and can it reclaim 2 with actual follow-through? If 2 keeps stuffing it, and 180 starts slipping, that's usually where the chase crowd gets trapped. XOS is the volume king on this board, and it's not even close. 68.9 million shares. Relative volume showing about 1,769 times normal. That is absurd. Price on the board is around 428, up about 105%. And remember the market backdrop here. QQQ is down almost 1.5%, so this is not just beta helping everything. This is its own tape. For me, the whole scorecard is that 450 reclaim. Below 450, yeah, it can still be a huge mover, but it's more of a churn and reset look. Above 450, especially if volume starts building again on the green candles, then you can say contract volume momentum is trying to rebuild instead of just fading the morning spike. Small float too, under 8 million, so this can whip around fast. I'm not chasing the headline. I'm watching whether 450 turns from ceiling into support. Now, Wedo, totally different personality. Higher priced momentum name, around 43 on the board, up 75%, 4.3 million shares, and relative volume about 95 times normal. So the liquidity is real enough to matter, but this is also a 5-point candle type of stock if people get sloppy. The old line here was 39, and so far that's the scorecard I care about. If 39 is still holding, the move is still structurally intact. Sellers are probably going to show up into those round number pushes, 44, 45, that kind of area. But I don't want to overcomplicate it. Above 39, buyers are still defending the reclaim. Lose 39, and then the character changes from momentum hold to failed breakout watch. And with Wedo, because it already has a huge range, you really want confirmation on the 1 minute tape, not just a green quote on the board. Alright, SLE and EJH. This is the small cap momentum pair now. And these two are not the same trade at all. SLE is around $5, up about 68%, 26 million shares, and the float on the board is tiny, about 1.6 million. So when this thing moves, yeah, it can move fast. But the scorecard for me is still super simple. 650 is the first real reclaim zone, and then 7 is the clean momentum line. Under that, it's still just a big bounce inside a very noisy small cap tape. Now EJH, totally different feel. Around 211, up 45%, 13.8 million shares, relative volume over 100 times normal. The line here is $2. If EJH holds 2, okay, there's at least some structure. If it starts living below 2, that's where this can turn into microcap churn really fast. Pop, fail, fail. So SLE is the cleaner continuation candidate visually if it can reclaim those upper levels. EJH is the one where I'd be way more strict about the $2 line. Last pass on the board here. Quality and liquidity check, because not every giant percentage move is the same thing. AMLX is the cleanest liquidity name in this bottom group. $30, up about 41%. 8.5 million shares, 5 times relative volume, and this is a $3 billion biotech, not some tiny $2 million shell. That matters when the tape is sloppy. QQQ is still down about 1.5%, and AMLX is green with real volume. FNG, though, be careful reading that like a normal stock. It's an ETF, down about 36% on only 250,000 shares, so that can be basket mechanics, creation redemption stuff, or just a weird print. I'm not treating FNG like a single company blowup. And then LGCL, 30 cents, down almost 79%. That is classic sub $1 trap risk. Yeah, the float is small and the relative volume is elevated. But when a name is already smashed like that, bounces can look amazing for 3 minutes and then just vanish. So that's the board. Real liquidity in AMLX, ETF weirdness in FNG, and LGCL is danger tape. Coming up, let's shift off the pure movers board and hit the next setup with the same tape awareness, because this market is not giving anything a free pass today.
Thanks, Markets Desk. Let's pull this AI infrastructure theme up, because NVIDIA is the center of gravity again. Okay, so here at the company desk, the key question is not, is NVIDIA important? Obviously it is. The real question is, what actually changes when NVIDIA moves from being the chip supplier to also helping back the infrastructure build-out? Stocks around 220.23 in the data, down a little over 2%. And that matters because QQQ is already heavy, down about 1.5%. So this isn't a clean victory lap on the tape. Watch that 220 area on NVDA. If it can't stay above that round number while the story is this big, the market's basically saying, great growth story, but we're going to punish duration and financing risk today. Now, let's go to the actual catalyst, because this is the part that's different. The press release says, NVIDIA is guaranteeing SB Energy's Ports Pike Technology Campus in Ohio, exclusively for NVIDIA AI compute. Initial 4.25 IT gigawatts. Option for another 3.75. And OpenAI is the customer for the full 8 IT gigawatt campus project. That is not just we sold more GPUs. That's NVIDIA helping make the data center happen. Land, power, shell build-out, credit support. And that's the company desk wrinkle. It strengthens the demand funnel, but it also pulls NVIDIA deeper into the capital stack. More strategic control? Yes. More questions around balance sheet exposure, power availability, build-out timelines? Also yes.
Thanks, company desk. Stock Whisperer desk is up, and this is a risk management pass on the simulated paper book. We're not forcing a fresh long into this tape. QQQ's still down about 1.4%, sitting just under that 720 area the macro desk flagged. So the job here is simple. Protect what's working, don't average down on what isn't. In the paper portfolio right now, AVGO is red about $82, HOOD is red about 100, and TSLA is the one carrying the book green, up about 92 unrealized. Alright, let's go straight to TSLA because this is the only actual decision I want to make here. This is still a simulated trade, not something to copy, but the process matters. We've got 25 shares long, average is about 333.80, current mark is 337.49. So the trade is working, but it's not exactly a runaway tape. Growth is heavy, the Nasdaq is heavy, and when a long is green against that backdrop, I'd rather tighten the risk than start celebrating. The thesis is TSLA is showing relative strength, so we protect more of the game and give it room only if it keeps separating. Here's the bracket adjustment.
I'm raising the stop to 335.80. That's above the original entry area. So if the name rolls over, the paper trade should give back a lot less of the open profit. The take profit stays at 355. I'm not tightening the upside just because the market is red. No new shares, no averaging, no adding into weakness. This is just the stock whisperer doing the boring thing. Define the risk, update the bracket, and let the next candles prove it. Okay, that's the TSLA protection update on the paper book. Stop at 335.80, take profit at 355. The next clean read for me is 340. If TSLA can reclaim 340 while QQQ is still soft, that tells me buyers are actually treating it like relative strength, not just a temporary bounce. If it can't do that, fine. The bracket is doing its job. The key is not pretending a green P&L means the thesis can't fail. It absolutely can, which is why the stop got raised. Now, HOOD, this one needs an honest grade. We opened the simulated long at 94.50 on the S&P 500 inclusion catalyst, and right now it's marked 93.16, down about $100. That's not the follow-through we wanted. I'm not adding to it down here. The two levels are very clean for the paper book. 95.25 is the reclaim that would make the momentum look healthier again, and 92.40 is the risk line where the headline reaction is really starting to fail. Until one of those changes character, this is a defined risk hold, not a chase. AVGO is the other position we leave alone. 20 shares long, average 383.80, current mark 379.70, so we're down roughly $82, about 1%. And that makes sense with the tape. Mega cap growth and semis aren't getting a free pass, while QQQ is under pressure and yields are part of the conversation. I don't have a fresh reason to change the trade right this second. So the decision is no decision. Respect the defined risk, don't overmanage every red tick, and don't add exposure just because I want the book to look prettier. Last thing on the watch list, NVDA is still interesting, but only if buyers reclaim 223.50 despite the weak QQQ tape. I'm not preempting it in the simulated account. TSLA above 340 is the momentum confirmation. HOOD above 95.25 is the repair level, and HOOD below 92.40 is the warning light. Clean book, defined risk, one bracket updated. Coming up, we kick it back into a market mover scan.
Thanks, Stock Whisperer. Alright, Markets Desk is back on the movers board. QQQ is still heavy, down about 1.5%, so this board is not normal market beta stuff. This is active tape. NTWOW still sitting on top, up about 318%, but that one's already in prove it mode. PFSA, up 198%, tiny float, huge squeeze profile, but yeah, high risk name. AIXC, up 151%, real relative volume there. XOS still doubled with monster volume, SLE still green by 82%, and then oof, look at LGCL on the same board, down 76%, so this is not a friendly board, this is a knife board. We're going 1-minute charts only, quick scorecard, no wasted words. First chart is NTWOW, because top gainer plus shaky structure is exactly where traps show up. Okay, first chart, NTWOW. This thing's at about $1.17, still up north of 300%, and the volume is almost 800,000 shares, versus an average of basically nothing, around 4,500. So yeah, the move is real on volume, but the structure is not automatically clean. We already had the earlier scorecard on this one, and right now the print is underneath that prior floor. That matters. It means I'm not treating this like a clean leader, I'm treating it like a failed momentum test. If buyers actually absorb and repair it, fine, the tape can stabilize. If not, this is where the late chase gets messy. Shell company style mover, huge percentage gain, thin historical volume, candle closes matter more than one green pop. Oof, and any upper wick here after a 300% move? That's the market telling you people are getting trapped at the highs. PFSA next, and this is the classic tiny float squeeze profile. We're talking roughly a 604,000 share float, stock around 1350, up basically 200%, and the absolute volume is massive, at 19 million shares. But here's the catch, dilution risk is tagged high, so I'm not treating this like some clean institutional breakout. On the 1 minute, I want to know if that low teens bid is actually still there. If 13 keeps getting defended, fine, the squeeze is still at least alive. If it starts losing 13 and those bounce candles get smaller, That's usually where these turn from momentum into air pocket mode real quick. Now, AIXC. Different look, still spicy. This one's at about $1.78, up 150%, and the relative volume is actually clean here. 9.5 times normal, over 11 million shares traded. The line everybody's staring at is $2. You can see why. Every time these sub-2 momentum names get near that whole number, shorts lean on it, longs takes them off, and the tape either rebuilds underneath or just rejects and rolls. So for me, the read is simple. Is it basing under 2 with higher lows, or is this just another lower high rejection? Above 2, the character changes. Under that 170 area, you probably start seeing momentum tourists bail. XOS now? Yeah, this one's a totally different volume profile. Stocks around 422, still up basically 100%, but look at the tape versus the earlier microcap squeezes. 71 million shares traded. Relative volume showing over 1,800 times normal. That is wild. So at this point, I'm not rehashing the catalyst. The question is exhaustion versus reclaim. If these 1-minute bounces are coming on thinner volume and sellers keep stuffing it under the prior pop, that's where these 100% moves can turn into chop real quick. But if it keeps reclaiming $4 and holding above it with actual volume behind the candles, then the move is still alive structurally. For me, 4 is the obvious line on the screen. Lose that cleanly, and this starts looking less like momentum and more like late buyers getting tested.
Thanks, Markets Desk. Breaking from the macro desk, we're starting with industrials. ProTerminal's newsroom is tracking a fresh positioning story. Hedge funds' next big short appears to be industrials, basically a bet that the economy is about to make a weird noise under the hood. What we know, the reported pressure is aimed at economically sensitive industrial stocks, the stuff tied to orders, transport, machinery, capex, the real-world economy, not just the AI dream factory. What we don't know yet? The exact size of the short basket, which funds are leading it, and whether this is outright recession positioning or just a hedge against a slower tape. Market read right now, SPY is around 76.80, down 0.6. QQQ is already under that 720 line at 717.5, and IWM is off about 0.7. So this isn't happening in a vacuum. When growth stocks are heavy and cyclicals get targeted, the market is saying, show me demand. Very cheerful stuff for a Tuesday morning. Next headline, worker confidence in finding a new job has hit a record low in the New York Fed survey. That's not a stock chart, but it absolutely trades like one over time. What happened? Workers are saying they feel less confident about landing a new role if they need one. Why it matters? That can bleed into consumer behavior. Fewer big purchases, more caution, less willingness to stretch. And that lines up with the industrials short story. If households get defensive, companies start rechecking orders, hiring, inventory, all of it. Here at the macro desk, that's the chain. Labor confidence slips, demand expectations cool, cyclicals get the side eye. You don't need a crystal ball, you just need to watch whether the data keeps confirming the trade. And third headline, Fed dissenters are pushing back against an easing bias, saying rate hikes may still be needed to tame inflation. What happened? Several officials objected to the idea of leaning too quickly toward cuts. Why it matters for the tape? If growth anxiety is rising at the same time the Fed is not clearly offering relief, multiples have less room to breathe. That's why the cross-asset board matters here. TLT is basically flat at 81.38. The dollar is a touch firmer. Gold is down 0.7. Oil is still green near 131 on USO. And crypto equities are heavy. Coin down about 2.5. MSTR down just over 2. So the market isn't screaming panic, but it's also not exactly passing around party hats. Coming up, the movers board gets another pass, and we'll see which single names are actually fighting this macro tape.
Thanks, Macro Desk. All right, Markets Desk is grabbing IPST because this is the small cap runner on the screen right now. Oof, look at that candle. We've got a NASDAQ microcap, roughly 6 million market cap, trading around 10.75 after printing a low near 650 earlier. That's not a normal drift. That's a full-on momentum ignition candle, and it's happening while QQQ is down over 1.5%. So yeah, relative strength matters here. Here's the tape read. Early trade was choppy around 710, 720. Nothing clean, just base building. Then the character changes. Once it pushed through 736, then 750, buyers actually showed up. The big tell is the volume burst on the 770 to 935 launch. Over 170,000 shares in that minute, compared with average daily volume near 50,000. That's the difference between a random penny pop and a real liquidity event. But now it's parabolic. Day high is 1075, and the last candles are stalling right under that high. So the market's desk scorecard is simple. Above 1075, the squeeze is still alive. Below 935, that last impulse candle starts looking exhausted. Quick catalyst check, because with these small caps, I don't want to just stare at a green candle and pretend that's the whole story. On the news stack, we've got IPST tied to this IP strategy angle. Story protocol, data network, rights cleared AI training data, all that token treasury flavor. I'm not seeing a fresh same-day press release in the data we've got right now. The latest listed release is back in late June, so this looks more like momentum and theme chasing than a clean new headline at 10:15. That matters. When the catalyst is fuzzy, the chart levels matter even more. And now, the risk tage, because this is where small cap runners bite people. IPST has high dilution risk in the data, active shelf, active equity line, pending S1, and the runway listed is basically measured in days, not quarters. That doesn't mean the candle has to roll over right this second. The tape is the tape. But it absolutely changes how I grade the move. Above 10.75, buyers are proving they can absorb supply and keep the squeeze going. Lose 9.35, and I start treating that last burst as possible exhaustion. Lose 7.70 later, and that's the prior launch zone getting tested. Fast name, wide risk, no hero ball here. Coming up, we'll keep the movers board close because this tape is still jumpy. All right, markets desk back on the movers board. Tape's red, so I want the names still pulling their own oxygen. QQQ sitting under 720, down about 1.5%, so these green names are not getting help from the market. NTWOW is still top of the board, up over 300%, around $1.15. AIXC, still loud, plus 238%, near $2.40. PFSA is hanging around $12.40 after that wild squeeze. And then XOS, oof, that's the volume freak on the board. 72 million shares and nearly 1,900 times normal volume. I'm not going to read the whole board again. We're going straight chart by chart, starting with NTWOW, because that earlier $1.20 break got hit, and now we need to see if it repairs or stays broken. Okay, NTWOW on the 1 minute. This is the top name, but it's also the messiest kind of top. Tiny historical volume, shell company profile, and now suddenly 855,000 shares versus an average around 4,500. That's why the percentage is cartoonish. Current print's about $1.15, and the level that matters is still $1.20. Below that, momentum is damaged. Above $1.20 and holding, then fine, maybe the tape tries to repair. But if it can't reclaim that, I'm treating this like a squeeze that lost control, not a clean trend. No hero stuff here. Spreads can get ugly fast on these. AIXC next, and this one's cleaner than NTWOW in the sense that at least we've got real volume showing up. 15.6 million shares, up about 238%, sitting around 240. The whole read for me is that $2 reclaim. If this thing keeps building candles above 2, okay, the buyers are still defending the breakout zone. But if it starts living back under 2, that's where I stop calling it momentum and start calling it a failed reclaim. And don't ignore the background here. High dilution risk, small pharma style profile, 16 million-ish float. So yeah, it can move, clearly. But this is exactly the type where the chart can look gorgeous for 10 minutes and then the offering risk cloud just sits over the whole tape. Now, PFSA, totally different flavor. Tiny float healthcare squeeze. 600,000-ish float, 20.7 million shares traded, and it's still up about 175%, near 1240. But here's the key. That prior $13 area we flagged is not support anymore if price is underneath it. Now 13 becomes the reclaim test. If it can get back over 13 and actually hold there, fine, squeeze pressure can reappear. If it keeps rejecting low teens into 12, 11.50, that's where these tiny float names can unwind fast. And relative volume showing 0.8 sounds weird next to the move, but the average volume is already massive here, so I'm not overreading that as dead interest. I'm watching the actual low teens tape. XOS is the volume monster on this board. This is not subtle. 72.9 million shares, 1,872 times relative volume, and it's doing that while QQQ is still heavy under 720. So yeah, relative strength is real here. The whole 1-minute read, though, is the $4 battle. It reclaimed 4. It's trading around 4.12 now, and that's the scorecard for me. Above 4, the tape is still respecting the breakout. Back under 4 and accepting there, it gets a lot more chasey and sloppy. Also remember, this is still a 50-something million market cap name. High dilution flag on the board. So even with monster volume, you don't treat it like a clean mega cap trend. Watch the candles around 4. That's the line where buyers either keep showing up or the air pocket opens. Wedo next, and this one's a totally different animal. It's not a $2 squeeze. This thing's up near 41 bucks, up about 68%, almost 5 million shares traded, and roughly 110 times normal volume. That's big participation, but the liquidity can get whippy because the price is high and the float's only around 5.7 million. Board also has recent filings flagged, so I'm not ignoring that on a fresh mover. On the 1 minute, I'm watching whether it can keep holding above the 40 area. If 40 keeps getting defended, that's buyers saying they're not done with it yet. If it starts snapping through 40 and failing to reclaim, then the tape is telling you the move is getting thinner, not cleaner. Alright, AMLX now. And this is the cleaner healthcare momentum name on the board. Not clean like risk-free, obviously. It's biotech, but clean versus those tiny float squeeze machines we just ran through. You've got a roughly $3.5 billion market cap here, about 96 million in the float, 11.1 million shares traded, and it's still up 46%, while QQQ is down more than 1.5. That relative strength matters. The line I care about on this one is that prior 32 momentum area. It's sitting around 31.35 right now. So if it keeps rejecting under 32, that tells you buyers are still hesitating at the old push level. If it reclaims 32 and actually holds it, not just wicks through and dumps, then the tape looks a lot healthier. This is the one from the healthcare group where I'd rather judge the quality by volume follow-through than by pure percent gain fireworks.
Thanks, Markets Desk. Quick stop at the Stock Whisperer Paperbook. This is the show's simulated portfolio, not a copy me trade, and the new one is BALY, short 300 shares at 992, current mark's about 1001, so yeah, small red start, down 27 bucks, and I'm fine saying that out loud because the trade has to prove itself. The setup is simple. Pro Terminal flagged the going concern and funding worries, the stock broke down, and the failed bounces around that $10 area support a small continuation short. Bracket is already in. Buy stop at 1075, that's the risk line. Buy limit at 835 if the downside follow-through actually pays. The confirmation level I care about is 950. Below that, the breakdown has more evidence. Above 1075, I'm wrong in this paper book. Rest of the book, quick and honest. AAPL short is green by about 22 bucks, entry 309.97, mark 309.24. And with QQQ still down almost 1.5%, that thesis still has the tape behind it. 305 is the downside confirmation I'm watching. AVGO long is the pain spot, down roughly 114 bucks from 383.81 to 378.08. But the risk is defined at 369, so no drama, no averaging. HOOD long is down about 73 bucks, entry 94.50, mark 93.53, and 92.40 is the line where I stop debating it. Working brackets are sitting. AAPL 298 take profit, 316 stop. AVGO 410 take profit, 369 stop. HOOD 101.50 take profit, 92.40 stop, and BALY 835 by 1075. Cash is about 72 grand, and here at the Stock Whisperer, I'm not adding fresh exposure until one of these levels actually triggers.
Thanks, Stock Whisperer. All right, quick news brief from the macro desk. And we start with oil, because that's the thing kicking the furniture today. Brent crude is back over $90 a barrel after the US-Iran ceasefire lapsed. So the market is immediately repricing geopolitical risk, inflation risk, and margin pressure. Why it matters? Higher energy is basically a tax on everything that moves. Freight, airlines, consumers, industrials. And with SPY around 768 and already red, the tape does not need another rock in the backpack. Next headline. Bond yields are pushing to multi-decade highs. And this is the classic macro vise. Higher yields raise the cost of capital, pull on equity multiples, and hit the long duration stuff first, which is why QQQ's sitting near 719, down about 1.4%, matters more than the headline index level by itself. Growth stocks can still have great businesses, sure, but when the discount rate goes up, the spreadsheet gets less friendly. Spreadsheets, undefeated, deeply annoying. Third one is NVIDIA, and the company desk already flagged the bigger theme earlier. NVIDIA is not just selling shovels into the AI gold rush, it's helping finance the mine. ProTerminal's newsroom is tracking up to $105 billion in guarantees tied to OpenAI's Ohio data center build-out. That is enormous. The market takeaway is two-sided. It reinforces NVIDIA's ecosystem power in AI infrastructure, but it also means investors have to think about capital exposure and execution risk. In a strong QQQ tape, that story probably gets a standing ovation. In today's tape, it gets a standing ovation with someone checking the exit doors. Now, staying in AI for a second, Anthropic is being tracked at a $65 billion annualized revenue run rate as of July. It's private, so there's no ticker to pull up here, but the read-through is very public. Enterprise AI demand is still massive, and the cloud, chip, data center, and power chain names all care about that number. The catch is sustainability. A giant run rate tells you demand is real. It does not magically repeal competition, CapEx needs, or valuation gravity. Last one in this brief. Bally's is getting hit hard, down almost 29% after a going concern warning and funding worries. That's not just a single stock story. It's what happens when tighter financial conditions meet a leveraged consumer discretionary balance sheet. Equity holders start asking, who funds this, at what price, and how much dilution or refinancing pain comes with it? That's the real level here, not just the share price, but the cost of staying alive. Coming up, we'll kick it back toward the movers board and see which names are actually holding a bid in this risk-off tape.
Thanks, Macro Desk. All right, Markets Desk is jumping straight to the movers board, and this is the exact tape where you have to separate real momentum from junk squeezes. QQQ's down 1.4%. SPY's red, VIX is sitting near 1960. So when the board is showing NTWAV up 328%, AIXC up 273, PFSA up 226, that's not normal strength. That's event tape, squeeze tape, liquidity tape. Top row is NTWAV at $1.20, and yeah, that one just hit the reclaim level we flagged earlier. AIXC is next at 265, high dilution risk on the board. PFSA, tiny float, big price move. Then XOS, oof, look at that volume number, 74 million shares. 1,900 times relative volume. That's the one with the cleanest raw liquidity on this top group. Let's pull NTWO first. 1 minute chart. This is Newbury Street 2 acquisition, SPAC shell type name, not a normal operating company momentum leader, so keep that filter on. Price is $1.20, up 328%, volume just over 1 million shares against a 4,000-ish average. That's why the relative volume looks insane. 237 times. The scoreboard matters here. The earlier 120 reclaim hit, nice, but now the trade-off changes. If this candle can't hold $1.20 and starts living back under it, that's your failed reclaim look. That's where these things get nasty fast. If it keeps building above it, fine, squeeze stays alive. But I'm not treating this like clean sponsorship. It's a thin SPAC-style mover in a weak market. Here at the Markets Desk, the line is simple. 120 is the trap or repair level. Okay, AIXC is the next one. 1 minute chart up. This is the one where the $2 reclaim actually mattered. Earlier, if you were watching this thing, 2 was the line where it stopped being just a bounce and started turning into a real chase tape. Now it's sitting around 265, up about 270%, and the important part is volume hasn't totally disappeared. 16 million shares already, about 13 times normal. That's support for the move, at least intraday. But, big asterisk, dilution risk is marked high here, so I'm not treating this like some clean institutional breakout. This is still a small-cap pharma-type runner, where offerings, warrants, resets, that stuff can hit the tape fast. For me, the scorecard is simple. Above 2, bulls did their job. Now I want to see if dips are getting bought, or if every pop gets stuffed immediately. Now, PFSA. This one's a totally different animal. Price is parked right around 15 bucks. Call it 1480 on the board, and the float is tiny, about 604,000 shares. That is why this thing can look insane on a 1-minute chart. 24 million shares traded against that float is just wild turnover. So the 15 area is the pivot I care about here. Not because it's magic, just because traders are clearly anchoring to that whole dollar zone. If it's reclaiming 15 and holding, you can see how the squeeze mechanics stay alive. If it keeps wicking above and closing back under, that's where it starts looking more like exhaustion candles. Late buyers trapped, spreads widening, air pockets showing up. And with high dilution risk on PFSA2, you've got to respect that this is not a casual chart. This is squeeze versus flush territory, very fast tape.
Thanks. Markets Desk, breaking here from Pro Terminal. Bond yields are jumping and oil is surging after the US-Iran ceasefire expired. What we know right now is pretty simple. The ceasefire window has lapsed. Energy markets are repricing supply risk, and rates are moving higher as inflation pressure gets dragged back onto the front page. What we do not know yet is the next diplomatic step, any confirmed follow-on action, or how long this risk premium sticks. So for at the macro desk, the market read is oil bid, yields higher, growth stocks under pressure. QQQ sitting around 719.8, down 1.38%. SPY near 769, off about 0.5%. And VIX is up near 19.55. Not panic, but definitely not beach weather either. Next headline, the U.S. 10-year Treasury yield has climbed to 4.72%. That matters, because 4.72 is the cost of money headline today. Mortgages, corporate debt, equity valuations, all of it has to argue with that number. When long yields rise into a geopolitics plus oil spike, the market usually starts asking 2 questions. Does inflation stay sticky? And do earnings multiples deserve to be lower? That's why the pressure is heavier in QQQ than SPY right now. Tech can handle a lot, but it does not enjoy doing gymnastics with ankle weights. And one big, single name headline. Tesla is preparing an August launch of its Cybercab robotaxi with no steering wheel. The fact pattern here is autonomy, ride-sharing disruption, and a very real regulatory question mark. For TSLA investors, the issue is not just the product reveal. It's whether the rollout can translate into usable fleet economics, approvals, and consumer trust. Huge potential category, huge execution hurdle. Coming up, the Market Movers scan gets us back into the names actually trading hot on the tape.
Thanks, Macro Desk. Let's pull up MSFT, because this is a clean mega cap tell right here. QQQ is down about 1.4%, SPY red 2, and Microsoft is basically green, up a couple tenths near 481. That matters. On the daily, this is not a broken chart. Big rally from the 370s, pushed all the way above 500, tagged that 513 area, and now it's backing into the prior range. So here at the Markets Desk, the first question is simple. Is 480 support, or is 480 about to turn into a trapdoor? Daily levels first. Watch 480. That's the shelf. The pullback into this area has been pretty controlled, volume lighter to moderate, not some ugly liquidation candle. But oof, you can see the stall after that run into the low 500s. The upside range ceiling is 506, then that 513.73 high is the big prior high, Underneath, if 480 starts failing on volume, then the character changes. Not instantly bearish, but the market stops treating MSFT like the safe tech bid and starts treating it like another growth name under yield pressure. So scorecard, 480 support, 506 resistance, and right now, it's chopping right on the line. All right, let's drop down to the 1 minute. This is where it gets interesting. MSFT opened around 483.27, popped around, then got smoked. Quick air pocket from about 481.50 down into the 477.60 zone, and that wasn't random noise. Volume came in hard, over 100,000 shares a minute on those dump candles. Then buyers actually showed up. It clawed back into the low 483s, but now, look at the fade in energy. Current action is sitting around 480.80. Volume lighter, candles smaller, basically basing between 480 and 481. That tells me nobody owns this tape yet. Bulls need 483.90 to prove they're back in control. Bears need 478 to crack to prove that morning flush wasn't finished. So the quick markets desk grade on MSFT, daily still constructive, intraday still unresolved. Relative strength is real because QQQ is heavy and MSFT is not really participating on the downside. But don't ignore the wick damage from earlier. That 477.28 low is sitting there for a reason. I'm logging 480 as the line that has to hold, 483.90 as the reclaim that cleans up the intraday chart, and 478 as the downside warning. Coming up, we'll get back to the movers board and see if the small cap chaos is still carrying the tape. All right, let's hit the movers board fresh. QQQ's red, small caps are soft, and this board is still throwing absolute chaos. NTWOW sitting up 346% at $1.25. That's the first line on the board, and yeah, that 120 reclaim from earlier is still the whole scoreboard. AIXC right behind it, 259, up 264%, real volume there too, 17.9 million shares. PFSA, still wild, 1355, tiny float energy. Then WETO and XOS. We already scored those earlier, so I'm not going to waste your time rereading the same thesis. Here at the markets desk, I want the live charts now. Board is hot, while QQQ is down 1.3%. Okay, first chart, NTWOW 1 minute. This is the SPAC style mover at $1.25, up over 300%. But the key is super simple now, 120. That level already triggered once earlier, and now the question is whether it holds as support or turns into a trap. Volume is ridiculous versus its normal tape. 1.2 million shares against an average around 4,400. So this is not normal liquidity. But look, it's still a shell company name, 21 million market cap, and these can snap back fast. I'm not treating the headline percent as quality. I'm treating 120 as the score. Above it, the squeeze stays alive on the tape. Below it, that's the failed reclaim warning, and I'd expect traders to get way less patient. Now, AIXC. This is the next one I care about because that $2 reclaim is no longer just a cute little breakout line. It's trading up here around 259 now, up 260+%, and the volume is real, just under 18 million shares. So the quick read is this. $2 was the reclaim, but once you're this far above it, the cleaner tell is whether buyers can keep defending the mid-twos instead of letting it round trip back toward that breakout. And yeah, the backdrop matters. This is a high dilution risk healthcare name, so I'm not treating this like a clean institutional biotech trend. It's momentum first, risk management second, and if that 250 area starts slipping, the whole tape can get a lot messier fast. PFSA next, and this one's a totally different animal. Tiny float, healthcare squeeze, 25+ million shares traded, and it's sitting around $13.55 after that earlier $15 pivot didn't hold cleanly. So I'm not chasing the headline percent here. I'm asking one thing. Is $13.50 getting accepted, or is this just another lower high fade under 15? With a float around 600,000, these candles can look amazing and then immediately get violent the other way. If it can't rebuild over 15, that failed pivot stays the problem. If $13.50 keeps catching bids, then at least the squeeze still has a base to work from. Wedo now. Quick check. Because this one's not the cheapy penny stock type of chaos, this is a $50 name moving like a small cap. Board has it at 50.81, up about 1 or 6%, 5.7 million shares, and the wild number is 127 times relative volume. So for me, the whole read is simple. Is it still living above that $40 altitude line, or is it starting to lose air? Above 40, it's still a high-priced volatility squeeze. Back under 40, that's where the character changes, and you can start seeing these giant candles get way less forgiving. XOS. Super quick, because we already did the bigger thesis on this earlier, but this is the liquidity leader on the board. 75 million shares traded, which is just ridiculous versus a normal average under 40,000, and it's sitting right around 418, so the scorecard is really clean. Does $4 keep acting like support, and can 418 stay reclaimed instead of becoming resistance again? If it's holding above 4 with that kind of volume, traders are still engaged. If it starts accepting below 4, then the whole breakout gets a lot messier. No need to overcomplicate this one. Now flip it over to LGCL, because this is the ugly side of the same board. This is not momentum chasing, this is damage control. You've got a 29-cent stock, down 79%, trading over 20 million shares, almost 80 times relative volume. And the question is really simple. Is it basing, or is it just pausing before another leg lower? For me, the line is that 30-cent area. If it can't reclaim 30 and actually hold above it, it's still living under pressure. And with a float around 1 million shares, these candles can snap back fast, but they can also air pocket just as fast. Under 28-29 cents, I'm not calling that stable. Last rotation check here. AMLX versus the more speculative lower board names. AMLX is the cleaner one to me on the screen. $31, up about 45%, almost 12 million shares, and it's a real biotech market cap name, not just a tiny float microcap doing microcap things. That doesn't make it safe, obviously. Biotech can still be brutal, but the tape is cleaner than the lotto-style movers. Now give me SLE for a second. This is where the board gets thinner again. $4.30-ish, up 44%, 35 million shares traded, but tiny float, high dilution risk, and that means the levels matter way more than the headline percentage. And then Archon, quick glance, up 34%, but only about 300,000 shares. So the move is there, the relative volume is there, but it's not the same liquidity profile as XOS or AMLX. So that's the board. SPAC heat, healthcare squeezes, one ugly loser tape in LGCL, and a market backdrop where QQQ is still red. So you've got to separate real relative strength from just chaos. All right, let's leave the movers board there and pivot to the next read.
All right, quick pit stop. This whole tape we're watching is coming out of ProTerminal. And here at the markets desk, this is where I start when the small cap board gets spicy. First stop, dilution center. Not sexy, but man, it matters. Shelves, ATMs, offerings. That's the stuff that can smack a chart right when it looks clean. Now, flip back to the movers board. This is the heartbeat. Gainers, losers, relative volume, price, market cap, all in one shot. But key point, this is research, not a buy button. A name up 100% is interesting because it tells you where the volume is. It does not mean chase it. See XOS right there? Huge move, huge attention. And that's exactly when you want the rest of the context before you trust anything on the tape. And this is the second click. You've got the stock profile, then straight into filings. Oof, this is what saves you from getting hypnotized by green candles. If there's an offering, a shelf, a fresh 8K, I want to know that before I start talking like the move is clean. Then I'll check insider activity too. Not because one line item decides the trade, but because it adds context. Price action first, context right behind it. Then we're back to the 1-minute terminal chart. This is where the desk keeps score. VWAP, volume bursts, wicks, failed reclaims, all of it. Data can be delayed or incomplete sometimes. And this stream is educational only, but the workflow is the point. Movers board, filings, dilution, chart. That's ProTerminal. If you want the same setup we're using on air, go to proterminal.io. All right, coming up, we're back to the mover scan.
All right, promo's done. Markets desk back on the movers board because this tape is still throwing fastballs. QQQ's down 1.5. SPY red, VIX firm, and yet this board is still stupid green at the top. That's the whole story. Not a clean broad rally. It's isolated momentum. NTYOW still parked on top. AIXC and PFSA are right behind it. XOS and WETO are still alive, but we've already got scorecards there, so I'm not burning airtime unless those levels actually fire. The fresh job here is simple. Who's holding bid, who's just extended, and where does volume stop confirming? We start with NTYOW, because 320 relative volume on a SPAC shell is not normal tape. Okay, NTWOW on the 1 minute now. This is Newbury Street 2 SPAC shell, about a $21 million market cap, price sitting around 1.35 after a monster board move. Volumes 1.43 million against an average of basically 4,500 shares. So yeah, this is not normal participation. This is event-style liquidity hitting a usually dead name. Here's the level check. That 1.20 area we talked about earlier is still the line I care about underneath. As long as this keeps accepting above it, the squeeze hasn't fully cracked. But the upside needs proof too. I want to see it reclaim and hold 1.50 before I call it clean momentum again. If it spikes above 1.50 and immediately wicks back, that's not strength. That's trap behavior. Markets desk scorecard. Above 1.50 gets my attention. Below 1.20, and this turns into damage control tape fast. AIXC next. And yeah, this one's still ridiculous on the board. Up about 276%, trading around 267. Almost 18.8 million shares done. The scorecard for me is not the headline percent anymore. It's the mid-2 hold. After that reclaim earlier, I want to see if 250 to 255 keeps acting like a floor on the 1 minute. If dips get bought there and it stays above VWAP, fine, momentum's still alive. But if it starts living back under 250, that's where these late-day small cap charts can get ugly fast. And quick caveat, ProTerminal's got this tagged high dilution risk. So I'm keeping the excitement in check. Nice tape, real volume, but not a name you treat casually. PFSA now. This is the tiny float chaos one. Price is around $13.90, up a little over 200%, and the float on the board is only about 604,000 shares. So yeah, it can move, but it can also rug pull candles out of nowhere. The level I'm grading is $13.50. If $13.50 keeps holding, the squeeze is still stabilizing. But that failed $15 push is the warning label. You can see how names like this poke through a clean round level, wick, and then trap the breakout buyers. So I'm not chasing the green candle here. I'm watching whether $13.50 holds as support and whether 15 can ever reclaim clean instead of just wicking and fading. IPST now, Heritage Distilling, and this is the fresh rotation spot on the board. Not the top percentage monster, but this is still up about 63%. Trading basically right on $12, and the relative volume is wild, about 112 times normal on 5.6 million shares. So for me, the whole chart is 12. Super simple. If 12 keeps acting like a pivot, and the candles keep accepting above it, then yeah, the bid is still there. If it starts slipping under 12, and every pop back into it gets sold, that's where this turns from momentum into a fade candidate. Also, high dilution risk on the board, so don't treat this like some clean blue chip breakout. It's a small cap booze name with a 6-ish million market cap, being traded like a momentum vehicle today. AMLX is the cleaner read versus the tiny float stuff. AMLX is up about 45% at 3109, 12 million shares traded, relative volume around 7 times normal, so still very active, but it's not the same microcap air pocket as PFSA or NTWOW. And that matters because QQQ is down 1.5% right now. If a $3.5 billion biotech is holding green like this, while the growth tape is red, that's real relative strength.
The thing I'm checking on the 1 minute is trend quality. Are dips getting bought in a controlled way, or is it just one big headline spike with lower highs after? Liquidity is better here, spreads should be more manageable than the little runners, but biotech can still move violently when the story is catalyst-driven.
Quick lower board rotation before we leave the gainers. SLE now, Super League. Lower on the board, but still a real move. About 426, up 41%, 35.7 million shares traded, against about 630,000 average. So yeah, that's a big volume expansion. Float is showing around 1.6 million, market cap under 9 million, and the dilution tag is high. So I'm not treating this like some clean institutionally sponsored breakout. This is momentum, VWAP, liquidity, and risk management. If buyers keep defending the VWAP area, it can keep grinding. If it loses that line, these low float runners can turn into air pockets fast. SXTC next. China SXT Pharma. About 523, up just under 40%. 10.6 million shares. Different feel here. Relative volume is only about 2.9 times. Recent filings are flagged, and dilution risk is high too. So the chart can still trade, sure, but this is one where the paper overhead matters. If it's holding above VWAP and the bids keep refreshing, fine, that's momentum. If it starts rejecting and volume dries up, that's where I'd call it more chasey than clean. Now flip it to the red side, LGCL on the 1 minute. This is the scorecard name, 27.5 cents down 80%, 25.8 million shares traded, about 100 times relative volume. Floats around 1.1 million, dilution risk marked medium, and the tape is ugly. So for me, the 28 to 30 cent zone is the whole read. 28 cents is the first little reclaim attempt. 30 cents is the real scoreboard. If it can't get back above 30 and actually hold there, it's still just a bounce inside a downtrend, not a real reversal. And if it keeps sitting under that zone, sellers are still in control. Simple as that. All right, that's the movers board. Some absolute rocket ships on the green side, but LGCL is the reminder that the same small cap tape cuts both ways. Let's hand it forward and get back to the broader market read. All right, let's pull up CBRG here. Quick deep dive because this chart is not subtle. Live chart's sitting around 448, and oof, look at that wick structure. This opened near 558, tried to hang for a minute, then sellers just stepped on it. QQQ's red today, yeah, but this is single name pressure. Here's the market's desk read. The real break was that dump from roughly 548 down toward 490. That wasn't a lazy drift. That came with a huge volume spike, over 580,000 shares on that push, versus an average volume profile that's normally tiny. So when volume confirms the break like that, I'm not calling it a dip buy tape. I'm calling it a sell pressure tape until it proves otherwise. The low is 446. That's the line. If CBRG loses 446, that's sellers pressing through the day's low. If it can reclaim 450 and actually hold above it, not just tag it and reject, then maybe you get the first little stabilization attempt. But right now, lower highs, lower lows, and the bounce is weak.
Thanks, Markets Desk. Breaking macro wire here. Bond yields and oil jump as the US-Iran ceasefire expires. Here's what ProTerminal's newsroom is tracking. The ceasefire window has lapsed, crude pushed back above $90 a barrel, and yields are being described at multi-decade highs. What we do not know yet, whether there's a new diplomatic extension, whether supply is actually disrupted, or how long this lasts. So no victory laps, no doom screenplay, just the market read. QQQ is down 1.68%, SPY's off 0.57%, VIX is at 19.64. The line here at the macro desk is oil above 90. That turns geopolitics into an inflation story, and inflation is the house guest rates never invited, but somehow can't get rid of. Next headline. Alphabet hits a $4 trillion valuation on AI optimism. The desk is seeing the bid tied to Gemini, plus stronger confidence around cloud revenue. So this is not just a vanity milestone. It's the market saying Alphabet is still in the AI leadership bucket. Why it matters. In a tape where QQQ is down almost 1.7%, a $4 trillion mega cap valuation is a huge statement about where investors are still willing to pay up. The flip side is obvious. The bigger the multiple, the less room there is for sloppy execution. AI enthusiasm is powerful, but at $4 trillion, the market is not exactly pricing this like a garage startup with a whiteboard and free pizza. Third headline. CPI data is being flagged as the next critical risk event. No number is printing right this second. This is about setup and sensitivity. With markets recently stretched, oil back above that $90 headline level, and yields already doing damage to growth multiples, inflation data becomes the match near the dry grass. Why it matters for investors? CPI can reprice bonds, the dollar, equities, and crypto fast, especially when the market is already nervous. We're not predicting a Fed path here. That's how macro people end up talking to houseplants. But we are watching whether inflation pressure confirms or calms this move. Coming up, the market desk gets the movers board back on screen.
Thanks, macro desk. Let's hit the movers board fast. Okay, look at this board. QQQ is down almost 1.8, SPY's red, VIX is green, and still we've got these absolute chaos candles in small cap land. NTWO up 385%. That is not normal flow. That's squeeze tape, thin tape, whatever you want to call it. AIXC still up 300 plus. PFSA nearly a triple. XOS still on monster relative volume, over 2,000 times average volume, which is just ridiculous. Here at the markets desk, we're not treating green as clean. We're sorting what has real bid, what's just air, and what's already starting to trap late chasers. First pull is NTWOO, because that one's top of the board and the scorecard is already live. All right, NTWOW on the 1 minute. This is the top line mover, 136 last, up about 386%, with 1.6 million shares traded versus an average volume under 5,000. Oof, that's the whole story right there. The volume expansion is insane. But the level check matters more than the percentage now. We already had 150 on the board as the clean reclaim line. If this thing can't live back above that, I'm not giving the headline move much respect. Under 120, that's where the squeeze starts looking tired to me. Not dead, but tired. This is a shell company tape, so I'm keeping it very mechanical. 150 above for proof, 120 below is the danger line, and everything in between is chop. Now AIXC, and this is the one where the headline percent move looks insane, but the risk tag matters. Board has it around 314, up about 342%, almost 19.3 million shares traded. Relative volume near 16 times. So yeah, massive attention. But dilution risk is marked high, and that changes how I read the rip. On the 1 minute, the whole question is this $3 area now. Is 3 turning into acceptance? Or is it just a pop over 3 that keeps snapping back? The earlier reclaim in the mid-2s is still the bigger line in the sand for the structure. If it's holding above that zone, the move hasn't completely cracked. If 3 starts failing cleanly, then the chart can get really jumpy really fast. PFSA next. Totally different feel. This is still a monster move, about 197%. Last board print around 1345, but the float is tiny. Roughly 604,000 shares. And raw volume is huge, almost 29 million shares, so every candle can look like a fight. I'm not going to rehash the old levels here. What matters right now is whether this thing is actually calming down, or whether it's still just whipping between liquidity pockets. With a float that small, a 1 minute base can turn into a squeeze, but it can also run pull with no warning, so I'm watching the candle bodies. Do they start compressing and holding a range, or are the wicks still doing all the talking? XOS now. This is the relative volume monster on the board. Not the biggest percent move anymore, but look at the participation. 79 million shares on a name that averages under 40,000. That's absolutely not normal tape. Board has it around 439, up about 110%. And the key thing for me is not pretending the old $4 reclaim is some brand new trigger right here. That level mattered earlier. Right now, mid-4s is the continuation check. Is it still accepting above that prior reclaim area, or are the 1 minute candles starting to lose momentum and build lower highs? And with QQQ down almost 1.8, this kind of volume sticks out, but high dilution risk, small cap electric vehicle adjacent name, so the crowd can flip fast. Now, flip Wedo first. This one's a different animal because the stock's already way up in absolute price, not a 30-cent lottery ticket. Board's got Wedo around 47.36, up about 92%, 6.6 million shares, and relative volume around 146 times normal. Float listed about 5.7 million, so yeah, it can move, but at this price, the spreads and wicks can get nasty. I'm watching whether the 1 minute is still making controlled pullbacks, or if every pop is getting slammed right back down. That's the difference between a clean high beta runner and a trap chart. Okay, now IPST. Similar percent bucket, but cheaper. 1381, up about 87%, about 6.9 million shares, relative volume 138 times. This one has the high dilution risk tag, so I'm much less interested in the headline move and more interested in extension versus fade behavior. If it's stretched miles above VWAP and volume is drying up, that's where these can unwind violently. If dips are still getting defended on real volume, then at least the momentum crowd is still there. Okay, last green side comparison here. SLE first. Then AMLX, because these are both up huge, but they are not the same trade at all. SLE is 466, up 54%, 36 million shares, 58 times normal volume. But look at the float, about 1.6 million. That's the whole story. Tiny float, high dilution risk tag. Communication services, gaming content name. And in this tape, QQQ still down almost 1.8. That kind of squeeze can be violent, both directions. For me, the SLE line is basically the mid-4 area. If it's living above 450, momentum traders are still interested. If it loses that zone and volume dries up, that's where these can do the air pocket thing. Now AMLX, totally different profile. 31 bucks, up 45%, 12.5 million shares. But the float is 96 million, market cap 3.5 billion. So yeah, big biotech move, but cleaner liquidity, wider institutional participation, less of that 1-minute low float chaos. I'd watch 31 as the tape check level on AMLX. Above it, it's holding the breakout look. Below it, you start asking if the move is getting distributed. And let's clean up the red side before we move on. LGCL first, because this is still ugly. 28 cents, down basically 80%. 30 million shares, 117 times relative volume. That prior 28 to 30 cent pocket is not just cosmetic now. That's the whole battleground. If LGCL can't hold 28 cents, you're talking about a penny stock unwind, continuing, and I'm not sugarcoating that. Medium dilution risk tag, tiny float around 1.1 million. China's software services name. This is exactly the kind of chart where bounces can look tradable for 30 seconds, and then just disappear. Now FNG, different message. This is not a single company blowup. It's an ETF tied to new tech and media, and it's down about 40% at 703. Relative volume isn't really giving us much here, but the read is pretty straightforward. In a risk-off tape where QQQ is already heavy, FNG sitting right around 7 bucks is a broader risk appetite warning, not just a one-off mover. All right, that's the movers board. Wild small cap green, some nasty red underneath, and the index tape still leaning defensive.
Thanks, Markets Desk. Let's slow down for an earnings name. DRD Gold. This is on today's earnings list, but here's the first thing from the company desk. I'm not seeing a posted earnings release in the feed yet, and there's no EPS estimate attached for DRD in our data. So this is more of a setup read than a clean reaction read. The stock's red, about down 1% on the quote, and against a tape where QQQ is down almost 2%, it's not exactly falling apart, but the 1-minute chart is definitely soft. Look at the shape here. DRD starts the session around the high 24s, makes a push toward 24.99, and then that bid just kind of drains out. Lower highs, lower lows, and the volume shows up on the down candles. That matters. This isn't some totally dead quote drifting lower with no participation. Sellers actually leaned on it. The first level I care about is 24.15, because that's where the chart is trying to base now. If 24.15 breaks, the earnings day tone stays defensive. On the other side, 24.78 is the first real reclaim area where I'd say, okay, buyers are at least repairing some damage.
Thanks, company desk. Quick market minute reset for anyone just joining. It's 11:06 Eastern, and the tape is risk off, but not panic off. SPY 768.3, down 0.57%. QQQ 717.1, down 1.75%. IWM 301.3, down 0.90%. VIX 19.66, up just under 1%, with breadth still mixed. Translation from here at the macro desk. The market isn't throwing the furniture, but Nasdaq is definitely sulking in the corner. The story is high duration growth getting clipped, while the rest of the tape tries to decide if this is a rates and oil problem or just a valuation air pocket. First level I'm watching is that QQQ 716.55 intraday low shelf. If Nasdaq can't defend that, sellers are still pressing, not just taking a coffee break. Cross-asset board is doing the explaining. Bonds have a modest bid. TLT 81.55 up 0.25%. IEF 92.95 up 0.12. So even if you only trade stocks, keep the rates complex on your second screen. Dollar proxy is flat at 28.10. Yen is barely softer at 57.52. Gold is lower, GLD 401.80 down 0.91. And oil still firm, with the oil proxy 130.87 up 0.45. That mix says not full flight to safety, more like investors are lowering the risk thermostat, while inflation keeps knocking on the door like it forgot its keys. Crypto split too. BITO up 0.69, but coin down 1.23 and MSTR down 1.92. So the coin can be okay, while the equity wrappers still trade like high beta tech. Next markers for me, VIX 20, that QQQ 716.55 shelf, and the calendar. Housing starts and permits at 12:30. Industrial production at 1:15. Coming up, we'll kick it back to the movers board, then a quick pro terminal workflow hit.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board, and this is not a normal tape. QQQ's down almost 1.8, IWM's red, VIX is sitting near 19.6, and the top of this board is still absolute small cap chaos. NTWAW up 432% at $1.49 on 392 times relative volume. AIXC up 321%, basically parked right under $3. PFSA still up 182 at 1280. IPST up 121, and XOS, this is the crazy one on raw activity, up 100% with over 2,000 times relative volume. So yeah, indexes are heavy, but the speculative board is still lit. We're not chasing the percent column here. We're going chart by chart. Is volume confirming? Is VWAP holding? Or is this just a squeeze that can rug pull in one candle? Let's start with NTWOW. This is Newberry Street 2 Acquisition Corp., SPAC shell company tape, and the board print is just wild. 149, up 432%. 1.75 million shares traded versus an average volume under 5,000. That's why the relative volume is showing 392 times. Now the level we already had on the scoreboard was 120 as the danger line, and price being back around 149 keeps it above that fail zone for now. But the live magnet here is 150. If this chart can actually accept above 150, that tells you buyers are still willing to pay up in the squeeze. If it keeps rejecting right around there, then I start watching how fast liquidity backs away. Oof, on these SPAC runners, the tape can look perfect until the bid disappears. So for me, it's 150 acceptance first, 120 danger line underneath, and no victory lap unless volume stays real. Next one is AIXC, and this is the cleanest whole dollar fight on the board right now. Board has it at 299, up 300+%, almost 19.7 million shares, and about 16 times relative volume. So yeah, $3 is the line. Not 280, not 350, 3. If these 1-minute candles can actually accept above it, meaning hold above 3 and not just wick through, buyers are still absorbing. If it keeps tagging 3 and living back underneath in the 290s, that's a fade tell. And the other piece here, Pro Terminal has dilution risk marked high, so I'm not treating this like some clean institutional breakout. It's a tape trade around a very obvious pivot. PFSA now, pull the 1 minute up, because this one's all about post-spike behavior, not the old levels we already talked through. Profusa sitting around 1280 on the board, up about 183%, and this is a tiny float healthcare equipment name, roughly 600,000 shares in the float. So when it moves, it can move stupid fast both ways. The question right here is whether 1280 is being defended on pullbacks, or whether rallies back into that area are getting sold. And don't let the 1.18 relative volume fool you. It's still done over 30 million shares today. That's wild against that float. High dilution risk too, so this is one of those level-by-level runners, where the candles matter way more than the headline percent gain. XOS now, and this is the one I wanted to pull up because the volume print is just stupid big. Board has 84.8 million shares traded against an average under 40,000, so yeah, that 2,176 times relative volume number is not a typo. Price is $4.21, up about 101%, and the whole read for me is that $4 area. If 4 is holding as support after the first explosion, that tells you dip buyers are still hanging around. If it starts accepting back under 4, totally different tape. Then it's less breakout and more late chase unwind. Also remember, this is a roughly 7.9 million float name with high dilution risk on the board. So I'm not treating this like a clean large cap trend. It's momentum, volume, levels. IPST next, Heritage Distilling, and this is a different kind of extension. It's at 1638, up 121%, volume just over 10 million, and the relative volume is basically 200 times normal. So the crowd is absolutely here. But the question now is whether buyers are still defending pullbacks or if we're just stretched above 16. That $16 zone is the magnet on this 1-minute chart. Above it, you can still see momentum traders trying to keep the move alive. Under it, especially if the bounces get weaker, that's where these thin movers can start doing the elevator down thing. Market soft, QQQ's still heavy, so when a small name is up triple digits into a red tape, I'm watching the pullback quality way more than the headline percentage. Last green name I want, before we hit the red side, is Weedo. Pull the 1 minute, because this is a totally different animal than the $2 grinders. Webus is 46.85, up just over 90%. And the relative volume print is 149 times normal. That sounds exciting, but at a $40+ price, with about a 5.7 million float, this can swing in real money fast, not little pennies, actual dollar candles. Now back on the board, the recent filings flag is lit too, so I'm not treating it like a clean little momentum name in a vacuum. I'd want that context in the background, especially with dilution risk sitting unknown. Quick red side check before we wrap the scan. LGCL is still heavy, 27.8 cents, off 80%, 32 million shares through it. That's still damage control tape, not a clean reversal read. And FNG, the new tech and media ETF, is at 702, down 40% on about 700,000 shares. With QQQ still weak, that fits the pressure under the hood, but an ETF wrapper can also trade thin, so I'm not reading it like a single company blowup. Alright, that's the movers board. Wild upside and tiny floats, ugly pockets on the downside.
Thanks. Markets Desk, breaking news first here from the macro desk. ProTerminal's newsroom is tracking the U.S. government taking a 10% equity stake in Intel. That is the headline, and it's a big one, because this isn't just normal policy support around semiconductors. This is direct ownership in a strategic chip company. What we know, the stake is 10%. It puts the government much deeper into Intel's capital structure, and it immediately changes the way investors think about governance, valuation, and political influence around INTC. What we don't know yet, the full terms in the feed. Voting rights, timing, restrictions, pricing mechanics, all of that detail still matters. Market read, semis were already carrying the whole AI economy on their back like a very expensive backpack, and now Intel gets a government stake. That can feel like stability to one crowd and uncertainty to another. Both can be true at the same time, which is annoying. But that's markets. Next headline. NVIDIA earnings are on tap, and the setup matters because the market is already leaning hard on AI leadership. ProTerminal's desk is seeing investors frame the report as a potential test of whether the AI rally still has enough fuel after Powell's rate cut comments. The why it matters is pretty simple. NVDA is not just one stock anymore. It's basically a mood ring for mega cap growth, semis, data center spending, and the Nasdaq. And with QQQ down about 1.8% on the tape, the bar is not low. The market isn't asking, is NVIDIA good? The market is asking, is it good enough for the price people already paid? Big difference. Third big one. Treasury yields are soaring. That's the macro plumbing story under all of this. And yes, the plumbing is where the expensive surprises live. Short-term government bond yields moving sharply higher means borrowing costs matter again, discount rates matter again, and long-duration growth stocks don't get the same free pass. That helps explain why the tape has that heavy feel. SPY off about 0.6, QQQ hit harder. VIX sitting just under 20. Higher yields can pull capital toward fixed income and make equity valuations work harder for the same multiple. So the quick map is, Intel is the policy shock, NVIDIA is the AI earnings test, and yields are the gravity. Coming up, we'll flip back to the movers board and see who's actually ignoring that gravity.
Thanks, Macro Desk. Quick tools break, because this tape is moving fast, and I want you seeing the same stuff we're using here at the Markets Desk. This is the dilution center in Pro Terminal. Not sexy, but super important. When a small cap name is ripping, I want to know if there's a shelf, an ATM, an offering risk, anything that can hit the bid out of nowhere. That's research. That's risk control. Now flip it back to the movers board. This is where we're finding the live tape. Top gainers, top losers, relative volume, price, the whole heat check. Look at the spread today. NTWOW still way up. AIXC still wild. XOS still sitting on huge relative volume. But the key thing, this board is not a buy list. It's a scanner. It tells you where the action is. Then you still have to check the chart, the filings, the float, the catalyst, all of it. Okay, let's use XOS as the example. I'm not rerunning the whole trade here, just showing the workflow. Profile page first, then filings. This is where you check what the company has actually filed, not what some random post says. Offerings, shelves, reverse splits, S1s, 8Ks, that stuff matters, especially when the stock is moving fast. And then the insider tab too. You're not trying to find a magic signal. You're trying to build context before you trust the move. And then, boom, terminal chart, 1 minute tape. This is what we're watching live. Candles, volume, wicks, reclaim attempts, failed pops. Oof, look at how fast these names can shift. That's why the data stack matters. Movers, dilution, filings, insiders, chart, all in one place. If you want the same setup we're using on stream, it's Pro Terminal. Sign up at proterminal.io.
All right, Markets Desk is back on the movers board. Risk off tape, but these small cap runners are still acting like their own casino. QQQ's down almost 1.8, SPY red, VIX sitting just under 20, and then look at this board. N12 still top, up 432%, AIXC up 245%, PFSA up 181, IPST up 131, XOS doubled. So yeah, the index tape is heavy, but the momentum tape is alive. It's just very, very selective. Here at the Markets Desk, I'm not chasing the percentage column. I want volume, I want levels, and I want to know if the bid is real or if these are just exhaustion pops getting sold into. Let's go straight to NTWO on the 1 minute, because this is still the headline freak show. Last board print, $1.49, up 432%. Almost 2 million shares traded versus an average of about 4,500. That's 437 times normal volume. Oof. And remember, our earlier 150 line did get hit. Scoreboard says yes, but now it's basically sitting right back under that area. That matters. A hit is not the same thing as acceptance. This is a SPAC shell name. Market cap around 25.5 million. So I'm treating this like pure tape and liquidity. If the chart keeps rejecting right around that 150 zone, that's trap behavior. If it starts holding above it with volume, different conversation. But right here, with the broader market red, this is not a clean comfort trade. AIXC next. And yeah, this one's got the perfect 2026 small cap cocktail. Pharma story, AI in the name, crypto in the name, and the tape is just going bananas. Last board print was 245, up about 245%, with 20 million shares traded. So the volume is real, but this is where I'm a little more skeptical on structure. The spot I care about is that prior $3 area. If this chart is still living under 3, that's not repair yet. That's still supply smacking it down. If it can actually reclaim 3 and stop immediately rejecting, then okay, maybe the tape starts to clean up. But until then, I'm treating 3 as the line where the Momo crowd has to prove it. And don't ignore the tag here, high dilution risk. That matters way more in names like this than people want to admit when the candles are green. Now, PFSA. This is the one where the float is the whole story. 604,000 shares in the float, that's tiny. So every reclaim and every flush is going to look exaggerated on a 1 minute chart. It's still up about 181%, trading around 1273. And I don't want to rehash the old setup, but the structure line is still 1280. That's the spot. Above 1280 and holding, the squeeze mechanics are still alive. Below it, especially if it keeps failing right at that level, then the chart is basically telling you the same buyers from earlier are getting tested. 31 million shares have already traded, but relative volume is only about 1.2 because this thing's been insanely active lately. So yeah, wild move, tiny float, high dilution risk, fun to watch, dangerous to overstay. IPST now. This one's not as absurd as NTWOW percentage-wise, but it's still a monster. Last board print 1707, up 131%, and the big number is 224 times relative volume. That is not normal liquidity for a craft spirits name. The danger zone for me on this one is the $16 area. Above 16 plus, you can still argue the dip buyers are hanging around and the tape is respecting the breakout. But if this starts living back under 16, then the extension risk gets very real because you're chasing a stock that's already doubled on the day. So watch the 1-minute candles here. Clean pullbacks holding 16 are one thing. Fast red candles through it are a totally different trade. Now, XOS. This is probably the cleanest tape read on the whole scan just because the volume is ridiculous. 86 million shares, 2,211 times relative volume, last print 418, up 100%. So yeah, the headline move is huge, but the level is super simple, $4. 4 is the breakout line, and honestly it's also the danger line. If XOS is above 4 and building, buyers are still defending the move. If it loses 4 and can't reclaim it quickly, that turns from breakout into trap mode fast. And with a 7.9 million share float and high dilution risk on the board, you don't want to be casual with this thing. The clean read is volume through 4, hold 4, or the trade changes. Alright, last lap on the board and then we'll hand it off. Wedo first, totally different flavor from the cheap runners. This is a $42 stock, up 71%, almost 7 million shares, and 154 times relative volume. So it's high price momentum, but thinner liquidity than something like XOS. For me, the obvious line on this kind of tape is the $40 area. Above it, bulls are still defending the move. Lose it clean, and these can air pocket fast. Now flip to SLE. This is more classic low float squeeze behavior. 481, up 59%, 39 million shares traded, and only about 1.6 million in the float. That's the kind of setup where $5 becomes the magnet and the trapdoor at the same time, so I'm watching whether it can actually hold a reclaim there, not just wick through it. Quick red side check too. LGCL is ugly, down 81% at 26 cents on massive volume. That's not a dip, that's liquidation pressure until the tape proves otherwise. FNG, down 40%, is the softer ETF-style pressure name, but it's not trading with the same crazy volume signature as these small caps. And then AMLX is the cleaner contrast. 3247, up 51%, biotech, 3.5 billion market cap, nearly 14 million shares. Way more liquid, way less microcap chaos. So that's the movers board. Risk-off indexes, QQQ still heavy, but under the surface the small cap casino is absolutely alive. Coming up, we'll pivot off the board and hit the next tape read.
Thanks, Markets Desk. Let's stay in chips for a second, because this semi-tape has a real story under it. I've got NVDA up first. Stock's around $219.42, down about 2.48%. And that matters because QQQ's already off 1.84%. So yeah, the Nasdaq is heavy, but Nvidia is actually underperforming the weak tape a bit. Here at the company desk, the question isn't just, is AI still hot? The question is, what does this actually change for the business? And right now, 220 is the quick repair line I'm watching on NVDA. Above 220, the dip starts to look less broken. Below it, sellers still have the wheel intraday. Now, pull up the news here, because this is the important part. Nvidia's latest company-specific story isn't just another chip demand headline. This Ports Pike announcement says Nvidia will be the exclusive AI compute infrastructure provider at that Ohio campus, with credit support around land, power, and cell build-out. Initial capacity is 4.25 IT gigawatts, with an option for another 3.75, and OpenAI is named as the customer for the full 8 IT gigawatts. That's huge scale. But it also changes the debate. NVIDIA isn't only selling into the AI build-out anymore, it's helping structure the build-out. That can deepen demand visibility, but it also brings more scrutiny around financing, customer concentration, power availability, and how much capital the ecosystem needs to keep this party going. Now let's flip to Intel, because this is where the theme gets weird in a very market-relevant way. The macro desk already hit the breaking headline earlier. The US government has taken a 10% equity stake in Intel. I'm not going to rerun every term. The company desk read is simpler. This can change Intel's cost of capital story, and maybe the confidence around domestic fab capacity. But it does not magically solve execution. It doesn't instantly win foundry customers. It doesn't fix process delays by itself. So the market has to decide whether Intel is being re-rated as a strategic national asset, or whether this is still a turnaround that needs proof quarter by quarter. On the INTC chart, I'd be careful about treating this like a normal single-day catalyst. This isn't an analyst upgrade. It's not a product launch. It's industrial policy showing up directly in the equity story. That can put a floor under the narrative, maybe. But it can also create new questions around governance, future government involvement, and what shareholders actually get if the business still has to spend aggressively. So for Intel, the real follow-through is not just today's candle. It's whether investors start giving the company more time to execute, and whether customers believe the manufacturing roadmap is now more credible. Now, AVGO is the cleaner read-through name for me in this group. Different story than Intel. Broadcom isn't the policy backstop trade. It's more of the AI monetization trade. Custom silicon, networking, infrastructure, the stuff that has to get bought if hyperscalers keep spending. So if the market is doubting AI capex, AVGO is one of the names where you look for relative strength or relative weakness against QQ2. No fresh company-specific headline in this data packet that changes the business today. So I'm not forcing a catalyst. I'm using it as a tell on whether investors still want the profitable AI supply chain, not just the headline AI winners. And then MRVL is the higher beta version of that same question. If investors are comfortable underwriting more AI infrastructure spend, Marvell can catch a bid with the group. If they start doubting timing, margins, or order visibility, this is the type of name that can feel it faster. So the arc today is pretty clean. NVDA is demand plus financing. INTC is policy plus execution. AVGO is monetization quality. And MRVL is capex sensitivity. In a risk-off tape with VIX near 19.7, I don't want to overstate any one candle. I want to see which of these can actually hold up when the easy NASDAQ bid isn't there. Coming up, we'll kick it back toward the movers board and see where the live money is still hiding.
Thanks, company desk. All right, markets desk. Back to the movers board. And yeah, this board is still wild. QQQ is down about 1.7, VIX is pressing just under 20. So if something is green today, it's doing it against a pretty ugly tape. Top row is still NTWOW. Ridiculous move. SPAC shell, volume way beyond normal. Then you've got PFSA, AIXC, IPST, XOS, all still stacked on the green side. But don't ignore the red side either. LGCL and FNG are still nasty. So this is not a calm board. This is momentum, air pockets, and a lot of names where the chart matters way more than the headline percentage. Let's start with NTWOW, because this is the one sitting at the top of the board, and oof, look at the profile here. Price around $1.50, up more than 400%, and volume is over 2 million shares versus an average volume under 5,000. That's not normal participation. That's a full liquidity event for a SPAC shell. On the 1 minute, I'm not treating this like a clean operating company breakout. I want to see if the bids keep stepping up or if every push just gets sold into with big upper wicks. When a shell name moves like this, VWAP matters, candle quality matters, and the tape can change fast. So here at the markets desk, we respect the move, but we don't fall in love with the move. PFSA next. This is the healthcare squeeze, and this one's different from NTWOW because the float is tiny. About 600,000 shares listed on the float, and it's already traded over 32 million shares. So yeah, that's why the candles can get violent both directions. We're around 1240 right now, up about 174%. But the read here is the pullback. I don't want to chase the headline number. I want to see if buyers are actually defending this current shelf. For me, the clean thing is, does 1230-ish keep catching bids, or do we start slipping under 1220 and it gets air pockety? And remember, dilution risk is marked high here, so with a low float healthcare name, the tape can look amazing right until supply shows up. Fun chart, but it's one you respect. Now AIXC. This is the one I want to reassess, because the first move had that fade and reload look, but you don't want to confuse a real bid with just a headline bounce. Price is around $1.85, up about 160%. Volume's 21 million plus, and relative volume is almost 18 times normal. So there is real activity here. The question on the 1 minute is whether dips into the low 180s are getting absorbed, or whether beach bounce is coming on lighter volume. If it keeps reclaiming 190 with candles closing near the highs, that's stronger behavior. If it loses 180 and can't snap back, then it's more of a churny liquidation tape. Same warning as PFSA, high dilution risk, so I'm reading the bid, not falling in love with the story.
Thanks, Markets Desk. Breaking from the macro desk, bond yields are climbing and oil is extending gains after the US-Iran ceasefire expired. Here's what we know. The desk is tracking oil pushing higher, with the story moving through rates immediately. Treasury yields up at multi-decade highs, and that's the combo equity traders really don't love. What we do not know yet is whether this becomes a deeper supply shock, or whether there's another diplomatic off-ramp. So no guessing game there. The market read is pretty straightforward. Higher energy is an inflation impulse. Higher yields tighten the valuation math. And growth stocks get the bill before dessert. Classic macro dinner party. Oil shows up late, rates bring a calculator, and nobody has fun. Next headline. U.S. stocks are slipping as oil-driven inflation fears build. ProTerminal's newsroom has the S&P and Dow down about 0.5% in the reporting, while the Nasdaq was also lower. On our live tape, SPY is around 767.9, down 0.6. QQQ is the weak one at 717.9, down about 1.65%. And VIX is sitting near 19.7. Why it matters? If energy stays elevated, investors start marking up cost pressure. Transportation, chemicals, consumer wallets, all of it. That doesn't mean every stock trades the same, but it explains why the broad tape feels heavier than the headline index move alone. And third, AI stocks are dragging the market further away from record highs. The specific name on the card is Micron, with the desk seeing MU down nearly 6% as the oil and yield move hits high-growth tech. This is the same cause and effect chain, just with a semiconductor label on it. When yields rise, long-duration earnings streams get discounted harder. And AI names, even the real businesses, stop getting a free pass. So here at the macro desk, the question isn't whether AI is dead. Come on, it's not a funeral. The question is whether the market is willing to pay peak multiples while oil and rates are both leaning on the tape. Coming up, we've got candle chart analysis on WFF. So we'll flip from macro weather to the actual candles.
Thanks, Macro Desk. Let's move that risk-off backdrop into one earnings name. DRD Gold. All right, first thing, the chart is not giving you a victory lap here. DRD's around $24, down about 1.3%, and the 1 minute tape has been lower highs, lower lows, basically all morning. Day high near 24.79, day low just under 24, and right now it's trying to hold that $24 shelf. So for me, before we even talk earnings, watch 24 on DRD. If that cracks cleanly, the market's telling you the print or the setup into the print is not being rewarded yet. Now here at the company desk, the question is always, what does this actually change? DRD is on today's earnings list as an unscheduled name. And in the data we've got, there's no EPS estimate attached and no fresh press release crossing yet. So I'm treating this as an earnings watch setup, not a full reaction to a confirmed report. The business is pretty specific. This is a South African gold tailings retreatment company, not a flashy growth software story. It recovers gold from old surface tailings. That means the earnings swing is usually about realized gold prices, processing volumes, unit costs, and how much cash is left after capex. The last financial set in the feed showed revenue up sharply year over year, about 4.8 billion versus 3.8 billion in the comparable period. And net income also stepped up. So the bar is not just, did gold help? The bar is, did they convert that gold backdrop into actual cash flow without costs eating the whole benefit? And look, the balance sheet is the part that makes this a little more interesting than just a commodity ticker bouncing around. The latest balance sheet in the feed shows very little debt, roughly 21 million total debt, against about 1.7 billion in cash and equivalents. So net debt is actually negative. That matters because gold miners can look great on earnings and still punish shareholders if capex, project spend, or balance sheet stress is creeping up. Here, free cash flow was positive in the latest period, about 626 million. But capex was heavy too, over 1.5 billion. So the earnings question is pretty clean. Are they still generating enough operating cash to fund the asset base, support returns, and keep the balance sheet clean? If the answer is yes, that's a real business quality update. If it's just higher revenue with more spending pressure, then the market may shrug. Let's bring it back to the tape, because this is where the market votes in real time. DRD is sitting closer to the day's low than the day's high, and the bounce attempts into 2430 have not stuck. So the two lines I care about on this earnings watch are simple. Below 24, sellers are still in control. Above 2430, you at least start to see repair. And that's against a market where QQQ is off more than 1.5% and VIX is sitting near 20. So risk appetite is not exactly generous today. Bottom line, solid historical growth, clean balance sheet, but the stock is not acting like buyers are pressing ahead of the update. Coming up, we'll get more tactical with the WFF candle chart analysis.
Thanks, company desk. All right, markets desk grabbing WFF on the 1 minute. This is a clean little intraday story. Early tape was ugly, lower highs, lower lows, slipped from about 257 down into that 238 area. Then the character changed. Around the middle of the chart, buyers started stepping up, higher lows start printing, and the thing rebuilds back toward 260 plus. In a red tape, QQQ down about 1.7%, SPY red, that shift matters. Not calling it magic, just saying the candles stopped acting broken. Now watch the volume bars, because this is where the chart gets interesting. The first real push is that move from roughly 2.48 up through 2.57. Volume comes in with it, so that's not just a sleepy drift. Then later, from about 256 into the 269 high, same deal. Volume confirms the push. That's what the markets desk wants to see on a recovery tape. But, and this is the big but, after 2.69, it stalls. Latest candles are hanging around 2.57, 2.60-ish, and volume is tapering. So the fight is simple. Does this base keep holding, or was 2.69 the exhaustion pop? I'd mark 2.55 as the near-term support shelf. If WFF loses 2.55 and can't snap back, the base starts looking tired. On the upside, 2.69 is the lid. Clean acceptance above 2.69 would be the chart saying buyers are actually taking control again. So, scorecard on WFF. Early weakness, strong repair, volume-backed rally, now a pause just under the high. Oof, that's exactly where traders get chopped if they chase every green candle. The cleaner read is the range, 255 underneath, 269 overhead, current price sitting near 257. That's a base, not a breakout yet. If it stays tight on lighter volume, fine, that's constructive. If the bid disappears under 255, different story fast. Coming up, we've got a Pro Terminal promo on deck, so we'll show the workflow behind these chart hits in a minute. All right, that's it from the markets desk. QQQ stayed heavy. VIX is still parked near 1965, and the scoreboard stays live. XOS 4.20, WFF 2.55, and 2.69. Manage the risk, respect the tape,